This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Donald Trump needs a weak dollar.
I didn't hear too many bullish cases for China in 2025.
With Lisa Mateo on markets.
The economic calendar jam-packed today.
And Michael Barr with news.
Trump took steps on everything from TikTok to the southern border.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming as well on YouTube, so head over to youtube.com, search Bloomberg Podcast Live. That's where you find us. Tom Keene is out today. He is salvaging his bracket, is kind of what I'm expecting to see, with a beverage of his choice in his hand on some Upper East Side cafe. Damian Sassower sitting in for Tom. Damian, what are you looking at today? How's your bracket after day one?
I'm actually still in it. I mean, I got 3 out of the 4 upsets yesterday. McNeese. So
You
yeah,
had
shout
McNeese?
out. Yeah, I did have
Nice.
McNeese. I actually have been going places. Yeah, for me, it's got to be the spending bill out of Germany.
Yep.
I mean, that is driving markets here, and the fact that that's going to pass is going to be good news for value, good news for European equities, and potentially good news for Ukraine. We'll see.
Yep, we got a lot of stuff coming up here today. We're going to kick it off strong. Janet Rilling, head of the fixed income asset team at Allspring Global, is going to join us here to talk about this bond market. We're efforting Guy Johnson to figure out what's going on at Heathrow.
Mm-hmm.
I mean, don't you have I have a generator. Don't you have a generator?
I thought you
So
said.
we'll
I thought we were going to say you have a jet, not a generator.
No, the jet, and Tom's got the jet. So we're going to talk all about these markets. Michael Weiss is going to join us, CIO and founder, president of Yield Street. Talk about the alternative investment business. Fixed. We're talking about hedge funds, private equity, private credits. We got a lot of smart people coming up today to bring us up to date on all the news, all the market moving news, and we will kick it off with Mr. John Tucker.
All right, all the subs in today. Some of the earnings news casting a bit of a gloom over the market. You had FedEx tumbling after cutting earnings forecast. Nike also sliding. It signaled declines in profitability. Right now, the Dow futures, they indicate a lower open on Wall Street, down 109 points right now. The S&P E-minis, 15 points lower. The NASDAQ futures right now, they are down 69 points. Yields real quick, 2-year down 2 basis points, 393. The 10-year, the benchmark, down 2 basis points right now. That is at 421. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Damian, Paul.
All right, John Tucker, thank you so much. We appreciate that. Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming on YouTube as well. Boy, the top story on the Bloomberg terminal: London Heathrow closed by a fire and biggest disruption in decades. Guy Johnson joins us here. He's host with Bloomberg Television. He's at Heathrow. Guy, this is really an extraordinary event. What is the latest reporting?
This is an unprecedented event. I think Heathrow hasn't seen this kind of outage, as you say, in decades. So basically, let me just give you a bit of history as to what happened last night. Around 12:30, the fire brigade gets called. There's a fire at a electrical substation nearby. What happens next is absolutely cataclysmic. Basically, the whole of the area goes out, including Heathrow Airport, as a result of which Heathrow, the busiest airport in Europe, has to completely shut down. This is absolutely unprecedented, as you say. Why haven't they got a generator? Why haven't they got a backup system? What is going on here? Anyway, around 1,300 flights in and out of here on a daily basis. That is not happening. Nothing's landing, nothing's leaving. All the terminals are closed. We're told it will not reopen until around midnight tonight. But I have to say, guys, it means probably that we're going to see disruption in and out of Heathrow, in and out of global airports, probably for the next 2 or 3 days. Aircraft are out of position, crews are out of position, passengers are very much out of position as well. So this is a big deal, and it looks like it's not going to be done just yet.
Guy, I put on my insurance assessor hat, and I have to ask the one question: who's at fault here? Who is at fault? I mean, you're going to have missed connections, people staying in hotels on airport floors. There's going to be people who are insured for their flights. I mean, who's at fault? Who are we coming after here?
Damian, you're not even allowed to get into the airport. All the airport terminals are closed.
Wow.
They've completely shut everything. You can't even get in right now. That's the kind of the extent that we're dealing with here. Look, we don't know the answer to that question. I suspect you are probably not going to see payouts from the airlines. They basically are covered in an extraordinary event like this, so they're probably in the clear. I would have thought the insurers certainly will be taking a fairly big hit ultimately, you could argue it's probably down to the power system provider and it's probably down to Heathrow. Why on earth do we not have the kind of redundancy that is required to make sure that this kind of event does not happen? I suspect that's probably where the buck stops, Damian.
Guy, are we expecting to hear from airport officials at some point today to give us an update on kind of when this thing might reopen?
They're updating. We've just heard from the fire brigade, so the fire is out. So they were called just after midnight. They got the fire under control at just after 6:30 a.m. this morning. So the fire is out. So obviously they've now got to figure out how to get the power back on again. At the moment, there's no updates. At the moment, Heathrow is indicating that the airport will be closed until circa midnight tonight. That's the information we have at the moment. They're basically saying that this is an electrical fire. There probably isn't any foul play. The energy minister's been talking this morning. Obviously, a lot of people are talking about sabotage. The government is ruling out that at this point. But at the moment, we simply do not know what happened. There's a complete lack of information.
All right, Guy Johnson, thank you very much for your reporting directly from Heathrow Airport. Guy Johnson, Bloomberg Television. He is our London anchor. He is at Heathrow, and he'll be giving us some updated reporting throughout the morning. So, again, Heathrow shut down for the entire day. I think about Heathrow, just these monster planes from all over the world coming in and out nonstop.
Well, Paul, I think it's interesting that Guy points out that there's no nefarious activity, right? That it was an electrical kind of generator-related issue, hopefully. But then again, I asked the same question: who's at fault here? Somebody's gonna pay for this.
Yeah, and can you put a backup generator like I have in my backyard
for an airport?
They're going to need more than a few.
You think? All right,
your
so
Generac.
Yeah, my Generac is not going to get it done. All right, we'll have continued reporting coming out of Heathrow because a lot of folks are being displaced and inconvenienced, to say the very least, over there in Europe. Let's get back to these markets here. Janet Rilling joins us. She's head of Plus Fixed Income at Allspring Global Investments. Janet, thanks so much for joining us here. I'm seeing yields pull back here. I got my 2-year Treasury at 3.93%. I've got my 10-year at 4.21%. Is that where a fixed income investor should park their money, or maybe take some credit risk here? How are you thinking about these fixed income markets, Janet?
Well, good morning. Yeah, a lot going on in the fixed income markets these days, and we have seen rates go down. And that really plays into our general theme this year, and that we think people should be allocated to fixed income because it does provide that ballast in a portfolio. So across the curve, we think it makes sense to be diversified, but we do favor the 5-year part of the curve. We think that's a place to take an overweight position in the current environment. And regarding your question on taking credit risk, we think you can really tilt your portfolio right now to high quality. You get incremental income there, and that is because yield is available across global fixed income markets. You don't really have to dig down deep in credit. But we do recommend having some allocation to credit to get that incremental yield. Just a tilt more, though, to high quality credit.
Janet, you mentioned the 5-year, and let's just talk the curve for a second here. 530 is up 16 basis points year to date, while 2s, 10s, and 2s, 5s are flatter on the year. We're at 56 basis points. If we're buying 5s here, what does that mean for term premium looking out along the curve?
Yeah, we had a steepener position on through most of last year and coming into this year, but we've taken that off as we think that the curve has done quite a bit of steepening. Further, we don't think the pressure out the curve is going to be quite as strong due to issuance, given what we've heard from the Treasury Secretary. So that is why we're favoring the 5-year. Further, as the Fed has continued to have more dovish comments, the 5-year is more anchored to what the Fed is doing.
Janet, we knew going into this year that it was going to be U.S.-centric narratives, the U.S. exceptionalism narrative, so to speak, that was going to drive markets. Well, look at how things have changed, right? Just a few hours ago, Germany approved that big legislation, the massive investment in military and infrastructure. Talk to us a little bit about what that means for global bonds, i.e. non-U.S. dollar-denominated fixed income.
Yeah, European credit has been an area of opportunity in our view. We've been last year, we're shifting some of our U.S. credit into Europe. In the current environment, though, U.S. spreads have underperformed and Europe has outperformed because of the dynamic of all the volatility in the U.S. What we see with the fiscal situation in Europe, that will likely provide some stimulus to the European economy. Certainly, they're also suffering from the challenges of slower growth and inflation headwind. But that fiscal stimulus could provide a little bit of a growth catalyst for Europe. So we do think, again, good diversification in your portfolio makes sense. There is still a lot of good opportunity in the US, but having an allocation to European credit in your portfolio, we do think makes sense.
Janet, there's a lot of economic uncertainty out there, been building over the last couple of months as it relates to economic policy coming out of Washington. Have you made any changes to kind of your portfolio structure to reflect what is maybe a heightened uncertainty in the marketplace?
Yeah, so in terms of our duration posture, we did come into the year more neutral to reflect that wide range of outcomes. And then when we've taken duration exposures, they've been more tactical and more modest because, as you rightly know, the headlines change by the minute and the valuations move quite a bit as well. Again, having a higher quality tilt in the portfolio has been a focus for us, having dry powder. The one change we have made is starting incrementally to add more corporate credit. We have been underweight investment grade and high yield. And given the backup in spreads, given all the volatility, we started to nibble both in investment grade and high yield.
Janet, we're looking at OIS here, pricing in 225 bip cuts by October with the addition of maybe a 50% probability of a third cut by the end of this year. Is the market getting things right here?
Well, we certainly don't expect any cuts here in the first half. Our base case is 1 or 2 cuts in the second half of the year, but clearly the data is going to dictate that. The Fed came out this week talking, again, a bit more dovish, definitely on hold, and really characterizing the risks as balanced at this point. The fiscal is really, I think, what's going to drive the activity of the Fed. And so they're in the same position as investors, waiting to see what policy actually gets enacted and then seeing how that filters through the data. At this point, we haven't seen much really coming into the data. Tariffs have not been enacted yet. Any of the policy initiatives, haven't been in place. So we are watching the data closely. Really, the place we've seen the impact has been sentiment. And certainly sentiment can work its way into the hard data, but currently it's more in the soft data that we're seeing the impact of all the uncertainty.
Janet, I've got your University of Wisconsin Badgers getting into the third round of the tournament. How far do you have them going?
Well, first of all, I can say I'm already out of the bracket situation because I didn't fill one in. However, I was happy to see that my Badgers have moved on, and I'm going to root for them all the way to the end.
Very good. All right, Janet Rilling, head of Plus Fixed Income at Allspring out there in Milwaukee, Wisconsin. Again, here's my Milwaukee call. Pound for pound, some of the best fund managers I've ever met were in Milwaukee, Wisconsin. I have no idea why, other than the University of Milwaukee has a good business school, I guess.
Well, I mean,
University of Wisconsin.
I think it's interesting that Janet thinks it's going to be fiscal, which leads the fixed income market, because that means she's a bond vigilante operating out of Milwaukee, Wisconsin.
Yes.
Not many of those.
Exactly. All right, let's switch gears. Let's go to international equity share. Damian, there's been, there's a rush of international equity buyers into the U.S. market, late last year, maybe even in the beginning of this year. I think that's reversed a little bit.
Yeah, I think you're right. It feels like it, and we're seeing that in ETF land, right? We're seeing a lot of people putting money to work in European equity ETFs and the like. And look, let's be clear. U.S. bonds, while they're up on the year, really haven't benefited from this drawdown in U.S. equities. And I think that speaks loudly to the fact that people are rotating out of the U.S. and into Europe.
Let's get to our next guest, Beata Manthe, equity strategist for Europe for our good friends at Citi. Beata, how are you thinking about opportunities in the equity markets here in Europe vis-a-vis the rest of the world?
So we have moved Europe to an overweight, a tactical overweight towards the end of last year on the basis of peak bearishness from the analysts in terms of recessionary level downgrades that since then reversed and moved to upgrades. And also from the investors' perspective, we've been seeing super bearish positioning, even more bearish on relative basis versus the US than during the European sovereign crisis. And we were thinking that was too much, right? Upgraded. Since then, Europe did well. And comes a few weeks ago, I've started to get the same questions, that a sense of deja vu from the previous years when Europe does well from low levels. Investors start questioning, oh, should I fade it, right? That's it for Europe. And that's where these seismic policy changes out of the European policymakers have come to place, right? So we argue that these could lift longer-term EPS outlook for European equities, making it a more interesting asset allocation proposition for international investors versus just a trade, right? So what is happening right now could put Europe on structurally higher PE. We argue even up to 2 PE points higher. So that's a rating of 10, 15%. So the longer term view is actually Europe has more to come. And what you've mentioned, the flows that have only really traditional inflows into European equity funds have only started a few weeks ago. And it is remarkable how strong these inflows from the US investors have been. Historically, it tends to be a good lead indicator on future outperformance as well, because that's the actual marginal buyer, right?
Well, here's the question. How much of the move is FX related and how much is fundamental and earnings related, right? You just pointed to the fact that, there's a lot of European investors that are kind of closing their positions here in the US and bringing money back onshore. Or is it US investors moving offshore for the very first time in a long, long time? What are your thoughts there?
It's a bit of both, right? So the negative argument about Europe that I've been getting for quite some time is Europe has no growth. There is no political leadership. Nothing gets ever done, right? So it's just that trade. This is changing. Now, I wouldn't say it's fundamentally driven yet, because we have not seen any fundamental upsides from the recent announcements. What we've seen is the downgrades stopping, and downgrades were the function of many reasons why EPS has been weak last year in Europe. And of course, that means that the entry point for positive deltas on the EPS is lower and easier in Europe, right? So we have these positive changes, Europe getting its act together from domestic side. And then you have the other side of the coin, what is happening out of the US. And for now, in our view, that's the DeepSeek effect, right? That's the market questioning the PE of the AI thesis and theme, not questioning the earnings levels there, questioning the PE. Therefore, perhaps if it's broadening, if some market players can do it on the cheaper, perhaps it doesn't deserve as high of a PE, which moves the investors as well to Europe. So these two arguments that have been headwinds for Europe beforehand are moving into tailwinds.
I mean, I might take the other side of this Europe train, Beata. I mean, I can see
Go on.
Germany funding everything it needs to fund infrastructure, defense, maybe Poland because they're right up against Russia and they've been doing it for decades. But how about the rest of Europe? Where's Italy going to get the money? Where's Spain going to get the money? Where's Portugal going to get the money? It just feels like this trade might be overblown a little bit. How do you guys think about that?
Look, there are any uncertainties around it. We know that there is enough money pledged, and there is political willingness and necessity to do that, right? But let's not forget that we are not only talking about the defense spend, which we think would boost the broader defense spend if it happens, and it's going to happen very gradually. We are not moving to 3% this year or next year, right? We think we are going to get there by 2029. So that would add on average 2% of EPS, but with a delayed effect per annum. And then we have this broader infrastructure spend out of Germany, where fiscal multipliers could kick in earlier the defense spend, and they also tend to be stronger. So you get more back on your GDP than versus on the defense spend. Also, the silver lining on this delayed positive effect on the GDP is that actually ECB doesn't have the pressure to stop easing, right? So you have the silver lining on the continuation of the cuts in the short term and the potential positive GDP upside and therefore EPS in the longer term.
All right, Beata, thank you so much. We appreciate it. Beata Manti, equity strategist for Europe for Citi. I'm looking at Citi. When I worked at Citi back in the day in London, we were out in Canary Wharf. We were like the first tenants out there. There was nothing, no rail service. The subway dropped you off like a mile away. You had to go back, hike through the snow both ways. It was a disaster. Now, It is unbelievable how built out Canary Wharf is.
If you could get there if the airport opens. But here's the thing, Paul, I have to ask you. I mean, I worked at Citigroup as well. I was down at 388 Greenwich 388. Yep. Have you been to 388, 390 lately? It's beautiful down there. I mean,
the worst elevators on Global Wall Street.
I think they have an escalator that gets you up to the 9th floor now.
Floor every single day.
No, but I think in all seriousness, Germany only represents 14% of the Euro Stoxx 600, right? Yep. So only 15%. So I mean, I know we're re-rating kind of higher from 14.5 to 16 times, but is it really justified? I think I'm on your side of the camp there, Paul.
But Citi, they make it very clear here. They say, hey, the long-term PE multiple for the European market has been about 14 times earnings. They think it could eventually rise to 16 times. So that's a re-rating of note, I guess. And, if you think the economic activity is going to pick up over, the next 5 to 10 years and on that higher multiple, there's some value there. So maybe that's kind of the call there. So it's interesting to see kind of rethinking Europe, because we've always just thought of Europe as a value play. Maybe now it can be a little bit more of a growth play. Futures minus 14 here on the S&P 500. The NASDAQ off about 69 points. That's 0.3%. The yields here coming in a little bit this morning, off about 2 basis points. So your 10-year Treasury is yielding about 4.21%. Alex Steele's WTI crude oil just under $68 a barrel. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, the futures indicate a lower open on Wall Street. S&P 500 up slightly this week. Today, there's going to be something of a test. You get expiration of $4.5 trillion worth of options. So you either have to exercise the contract or let it expire at the strike price. A lot of volatility, basically. FedEx tumbling. Right now, down 7% pre-market. They cut the earnings forecast. Nike also down 7% pre-market. That is sliding. It signaled declines in profitability. They're blaming tariffs. They make a lot of stuff in China and Mexico. Elon Musk seeking to reassure Tesla employees. The CEO referred to a little bit of stormy weather after the shares plunged more than 50% in just 3 months. They had an all-hands meeting broadcast on X. Musk saying, hang on to your stock. And right now, the S&P 500 futures, they are lower by 15 points. Dow futures down 132. The NASDAQ futures right now down 72. Young people, so that excludes everybody in this room, looking to save money on their increasingly expensive coffee, turning to a throwback, instant coffee. According to data from Nielsen, sales of instant coffee rose 24%. And spending is growing faster among Gen Z.
No kidding. I mean, Tom Keene with his Sanka.
Could you imagine?
You're not going back to your Sanka from back in the day?
Maybe Tang.
Tang.
Exactly. I can't tell you how much money my wife and daughter spend at Starbucks. Not just every day, like multiple times a day they're there. It's incredible.
What's it up to right now?
What?
Here we go. My double short mocha. Nothing. Starbucks, Route 35, Wall, New Jersey, $6.80. For nothing. Now, I go there once a week. That's my Saturday thing.
Upstairs, it's free.
Yes, it's free. Exactly.
Should point out.
I'm with you.
Exactly. All right, John Tucker, thank you so much. We appreciate that. As always, Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City, Lexington Avenue. We're streaming live on YouTube as well. Wells Fargo big bank, big investment bank. They got their broker-dealer license from my little firm back in the early 90s, Wheat First Securities. If it wasn't for my firm, there'd be no Wells Fargo Investment Bank. I'm just pointing it out there. Tracy McMillan joins us. She's global head of asset allocation strategy at Wells Fargo down in beautiful Winston-Salem, North Carolina. Hey, Tracy, we were just talking to a Euro strategist from Citi, talking about this potential re-rating higher of the European equity market, maybe giving it a higher valuation. How do you guys think about Europe as a trade here vis-a-vis the rest of the world?
Yeah, so we actually think that Europe does represent an opportunity for investors, but we think a lot of the recent good news is probably priced in. We have a neutral rating on developed markets, and of course that includes the Eurozone and Japan. And we think that, recent pricing takes us very close to our year-end target. So we're telling investors to be a bit cautious here. Some of the fiscal news out of Germany is positive for sure, but things like defense spending really aren't productive spending. So, we just be a bit more cautious here on developed markets.
Trace, you're global head of asset allocation at Wells Fargo, and I want to protect my assets. And let's put on our options hat for a minute here, and let's look at volatility. Let's look at the VIX. I think it's about 20 now, but it really doesn't feel like we've had that real shock, that real volatile episode yet. And if I want to protect against that, what are you seeing in the vol markets? Is now the time to buy put protection, write some calls? I mean, talk to us about protecting your portfolio.
Sure. Yeah. So one of the main ways that we tell investors to protect their portfolios is through diversification. And that means to hold a component of bonds in most of our allocations. It also means to hold a component of commodities in order to protect against inflation shocks, and to hold alternatives like hedge funds in portfolios where that's appropriate for the investor. So right now we see short-term bonds as a good buying opportunity, intermediate-term bonds as a good buying opportunity, but long-term bonds have had a pretty significant gain, and that's where most of the interest rate risk is. So if you're protecting your assets, maybe move some of your long-term bond holdings back into short-term bonds.
Tracy, what did you learn, if anything, from your Federal Reserve this week and kind of their view of the interest rate environment, given maybe some of this economic uncertainty we have out there from some of the policies coming out of Washington?
Yeah, so I think what we learned is that the Federal Reserve is being very realistic here, and they are waiting for more information, as they should. And as they wait for that information, market news, economic news is going to give them a better sense of the direction forward. And, of course, policy plays into that. And Fed Chairman Powell did acknowledge that tariffs were a consideration in some of their projections. But we are anticipating that the first quarter is going to be very weak. That's a lot of give back from a strong fourth quarter last year. And so it's an acknowledgement in their downgrade of growth that growth is going to be a bit slower. Their upgrade of inflation, we think, is right because tariffs do need to be factored into that equation. And then unemployment ticking up a bit, we also think it is in the right direction and takes them actually closer to our year-end forecasts.
Tracy, you mentioned tariffs. April 2nd looms large here. And, for me, I'm just curious, how has the narrative shifted in your mind since the beginning of this year? When you look at, global equities, obviously going into this year, we thought it was going to be very U.S.-centric, that those themes are going to play out. Now it looks like the shift is kind of toward Europe as sort of leading the charge. Certainly you look at BBDXY, down 3% year to date. Talk to us a little bit about how your views have changed in the last 2.5, 3 months.
Yeah, so I would say that over the past couple of months, what we've seen is rising uncertainty, but we had expected a period of choppiness here in the first quarter. So that's playing out pretty much the way that we anticipated at the beginning of the year. We still think that despite an economic soft patch here in the United States, that we'll see some additional strength towards the end of the year. So we're overweight U.S. markets because of that. We see the strength coming back, and we also see interest rates moving higher by the end of the year. And we think that that supports the dollar moving back up by the end of the year.
Stronger dollar. I mean, look, I don't disagree with you, but I mean, if you look at, non-dollar fixed income, right, that really has outperformed to the upside. I mean, I look at emerging markets. I'm an EM guy. I look at EM local. We're up 4.5%, 5% year to date. It's definitely the leader within global fixed income. Talk to us about that diversification. Does that extend to the emerging market complex?
It definitely does, especially in fixed income, as you're pointing out. So within fixed income, our largest weighting for U.S. investors is in U.S. fixed income. We don't have a developed market weighting right now in our strategic allocations, but we do have a weighting to emerging markets because we see quality improving in emerging markets, and we also see the attractiveness of the yields in emerging markets versus the U.S. and developed markets.
Paul, I can't believe Tracy just used quality in emerging markets in the same sentence.
She knew who her audience is. Hey, Tracy, just in U.S. equity markets here, what screens well for you guys these days?
Well, within equities, we like industrials and energy, communication services, and financials. And we like energy and industrials because we think that as we see manufacturing coming back to the United States, those two sectors should benefit from that. And also, the data center build out and the AI progress continues. So we think that energy, industrials benefit from that. Communication services we see is almost like a tech plus sector at a discounted price. So we like communication services, and financials should benefit from deregulation and also a steeper yield curve.
Tracy, thank you so much for joining us. Always appreciate getting a few minutes of your time. Tracy McMillian, she is the Global Head of Asset Allocation Strategy at Wells Fargo, located down there in Winston-Salem, North Carolina, a beautiful town home of Wake Forest University.
That's right.
Demon Deacons.
That's right, the Demon Deacons. Work Forest University, you mean? I mean, I hear it's pretty tough for
My
first years.
My choice was University of Richmond and Wake Forest, and I went to Richmond.
Oh, okay.
Yeah, which was the rival for Tracy McMillian's College of William & Mary.
Richmond. I think Richmond's in the girls, the ladies NCAA. Yeah, they have a good team.
Good. Yeah, looking pretty good. The men's team was down a little bit, but the women are doing very well here. Got a little bit of red on the screen here to finish up this week. I'm not going to make too much about it. S&P's off about 13 points. The Dow's off 118. And the NASDAQ's off about 64 points there. That's about 0.3%. The Tom Keene Memorial VIX Index sitting right at 20. That's kind of a level where it's a little bit elevated, but it's nowhere near the 30, which is where it really gets people's attention as it relates to potential volatility downside in the markets. Yields continue to come in a little bit, off about 3 basis points, 4.2% on your 10-year Treasury. I'm calling out Bitcoin because Tom's not here, off 0.6%, just under $84,000 per token. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg newsroom of this Bloomberg Business Flash. Futures indicate a lower cash open on Wall Street. Some of the dour earnings casting something of a shadow on the markets right now. Let me start, though, with something technical. NVIDIA, most active pre-market, down about 0.7%. The stock down 12% year-to-date, on pace to end the week down more than 2.5%. The 50-day moving average has fallen below its 200-day moving average, the bearish death cross pattern. Nike, second most actively traded right now after their earnings. They signal further declines in revenue and profitability. They're trying to clear out some of the old inventory through discounting. So, Damian, you can pick up some discounted Air Force Ones.
Thanks.
Yeah, just a shopping tip. Dow futures down 109, S&P E-minis down 12, the NASDAQ futures right now 57 points lower. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. It's your Bloomberg Business Flash. Paul and Damian.
All right, John Tucker, thank you so much. We appreciate that. Damian Sassower sitting in for Tom Keene, who is off today. Tom will be back Monday. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I think most of us kind of grew up with that concept of a 60-40 portfolio, 60% stocks, 40% bonds. But the more and more people I talk to, including registered investment advisors, when we go out on these road shows, alternatives, bigger and bigger piece of even individual investors' portfolios. I'm not talking 5%, 10%.
50, 30, 20.
I'm talking, 20, 25% allocation. I was shocked to hear that. But maybe in today's crazy world where there's a lot of uncertainty out there, that might be attractive. Michael Weiss joins us here in our Bloomberg Interactive Broker Studio. He's the CEO and CIO of Yield Street. Michael, when you talk to your clients, how do you talk to them about alternative investments as part of an overall portfolio?
So when we talk to people about alternative investments, what we're really looking to tell them is a healthy portfolio today, to balance your public market exposure, you need to have private markets as well. I think what has been called alternative for a long time is going to be known as essential over the next couple of years. What we're seeing more and more is that people want to get their growth exposure in the private equity markets and their bond exposure in the credit markets. And I think there's a lot of sense to that. As we look back in history, we have about half the number of public companies today than we used to have. And so if you're looking to benefit from the growth of companies and businesses, you need to have exposure to the private markets. As you think about where companies borrow money from, it used to be exclusively or almost exclusively the bond market. Today, the private credit markets are exploding. And so it's a natural progression of where people are going to continue to reallocate, reinvest, and build a healthy portfolio.
Michael, let's talk use of proceeds for a minute here, because this is where I get a little flustered. I mean, I'm hearing about all this money that's being raised in private equity and private credit going to dividend recaps, which are when a company takes out, a special dividend in order to pay back its old investors, So if I'm a new investor, I don't want my money going to pay old investors, if you follow me. Talk to us a little bit about those types of questions that you get from investors. How do you, get them comfortable with the asset class when increasingly dividend recaps are making up a very big part of the pie this year, certainly?
I think you got to take a step back and look at the overall private markets and understand sort of how do we think about allocation generally and why are people investing in the private markets. So we recently did a large study with one of the largest consultants out here, and 64% of respondents cited diversification as a primary reason that they want to be investing in the private markets. Now, when you think about how you allocate to the private markets and what is really the right experience for the customer, I think about that in terms of sort of three vectors. There's do it yourself, guide me, there's do it for me. Some investors out there, just like they come on and they pick a stock, they're going to pick different investment opportunities, whether it's a specific private equity opportunity or a specific private credit or a specific real estate. Then there are those investors who want to be guided. So they want to talk to an advisor, they want to come on the platform here at Yield Street. You can go ahead, ask or tell us a little bit about yourself. We'll ask you a few questions and we'll give you some guidance as to what a portfolio could look like. Ultimately, you will pick those several investments to have diversification. The third is a much more passive solution. Think about sort of the uptick from the 60s of 6% of U.S. households own stocks to today over 10 times that, right? What was that? Mutual funds, ETFs, more passive solutions that are highly diversified. So when we think about the right portfolio allocation, we think about diversification across the sector, across the asset classes. And you can do that here through our managed portfolio solution. So I don't think folks are thinking about specifically a dividend recap or others. I think people are focused on how do I get healthy diversification across sectors, many different names, many different assets, so I'm not exposed or overexposed to any particular strategy.
So for those, I'm going to speak for myself, when I want you to do it for me, where would you put a chunk of capital to work for me? Would it be in ETFs? Would it be in individual deals? Would it be in funds? How do you guys do that?
So the easiest way to do that, and the way we've come to market with it, is we've had a partnership with Wilshire. Okay. And we went out to Wilshire and said, hey, you guys have been building portfolios for some of the most sophisticated institutional investors for a long time. We want to bring that credibility and capability down to the affluent retail investor. So what you're going to see if you signed up today and put, let's say, $50,000 into a managed solution, you're going to be invested across different interval funds. You'd probably have 3,000 or 4,000 positions in the underlying interval funds. And the way we would try to weight your portfolio would be dependent on sort of your profile, your risk criteria. And ultimately, you're going to have 3 types of interval funds. It would be a Goldman, a Carlyle, and a Stepstone interval fund, real assets, credit, and private equity. And depending on your risk profile, we're going to weight that given investor to one side versus the other, more total return or more income. So again, quite diversified, a lot of sort of less volatility in the market, better opportunity for alpha, and being able to sort of generate value outside of the public markets.
Michael, you are the CEO of Yield Street. Your company has invested over $4 billion on behalf of 400,000 clients in such asset classes. Forget about private equity and private credit for a minute. Art, some of these other sort of alternative asset classes. And, you know, I'm also the producer and anchor for Bloomberg Business of Sports. And we just saw yesterday the Celtics go for $6.1 billion. I'm curious to hear, are your investors viewing sports as an asset class now? Do you believe that that's a segment of the market that, you know, investors are going to kind of clamor toward?
100%. So a couple things I'll tell you. Number one, in the past, we have been able to secure a co-investment for Formula One team.
Yep.
We've also had one of the most prolific fund managers who has a big sports media and entertainment fund make their product available on the platform. And I can't say too much yet, but there is a major sports franchise. It's not the Celtics, so don't jump, who is also in the process of a similar transaction. And Yield Street is going to have that product available for its customers and its investors. So I think when you think about, you know, the private markets, there's the traditional question, which is like, hey, how do I just, you know, easily get a chunk of change diversified across? And we're going to put that through interval funds and other types of solutions. But then there's the point you make, which is like, we could still be passionate about what we invest in and do interesting things, whether it's fine art or professional sports or otherwise. And I think Yield Street's a great place to do that. But more broadly, that's where people are excited. When you used to go to the dinner table and talk about an interesting public company, today you're talking about an interesting private company that you guys.
Full disclosure, I don't want to invest in the Jets. That's just for me.
Michael Weiss, thank you so much for joining us. Michael Weiss, CEO, CIO of Yield Street, with our news in New York City. Here's Michael Barr.
Thank you very much. Britain's Heathrow Airport has closed for the full day after an electrical substation fire knocked out its power. It has disrupted flights for hundreds of thousands of passengers of one of Europe's biggest travel hubs. London Fire Brigade Deputy Commissioner Jonathan Smith.
10 fire engines, 2 bulk foam units and 1 high-volume pump were on scene at the peak of this incident. This equates to approximately 70 London Fire Brigade personnel.
President Trump denied a report that Elon Musk would be briefed on the American military's contingency planning for a potential war with China. The New York Times says it cited multiple unidentified U.S. officials familiar with the plans. Bloomberg's Bill Ferries.
It highlighted, I think, some of the concern that people have about Elon Musk, perhaps conflicts of interest. He's obviously a major investor in China, and half of his company's Teslas are produced there. But the White House quickly pushing back, saying that it's all untrue and ridiculous.
Bloomberg's Bill Ferries. President Trump signed an executive order to dismantle the Department of Education. Trump says he'll return education to the state. Some teachers and administrators are protesting the cuts, calling for the president to consider the children who will be impacted. Former Secretary of Education Arnie Duncan.
Being an educator is never an easy job, but to feel that your own government is now attacking public education, is trying to dismantle public education, that's unprecedented in the history of our nation.
Arnie Duncan spoke to ABC. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Back to Paul, Damian, and John.
Michael Barr, thank you so much. We appreciate that. So, Damian, the business of sports, that's right. $6.1 billion, and they don't get the building for the Celtics. That's really amazing.
And you got to compare it to the Commanders. First of all, this is the NBA, not the NFL. Yes. NFL teams should command a much higher premium than NBA teams, right? But, I mean, the Commanders only went for $6.05 billion. This is the most expensive transaction in the history of professional sports. Amazing.
I mean, we knew that Snyder, the seller of the Commanders, was probably under some level of pressure. I guess it was more than we thought.
Well, Josh Harris looks like a genius right
Yes,
now. I mean,
he
that's all
does.
you can say. Again, once again, I mean, we're
Yes.
saying this all over again.
Once again, there you go. And it just shows you, while the cash flows might not be there for some of these teams on a year-to-year basis, the asset value is absolutely the story there. So great story there with the Celtics. S&P 500 off 15 points, the Dow off 130, NASDAQ off 69 points. That's a third of 1%. We're going to have more coming up. This is Bloomberg. Good morning.
You're listening to Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
All right, looking at these markets again, we got some green, some red on the screen here. We'll stay on top of that. The story this morning, Damian, coming out of London is just extraordinary with the closure of Heathrow, which is, I mean, that is the European airport, so it just impacts so many people. We're going to get the latest reporting there. Benedict Camel, Global Aviation Editorial Leader for Bloomberg News, joins us. Benedict, what's the latest reporting from Heathrow? How long do they believe it will be shut? When do they think they will get back to normal operations? Do we have any news on that?
So the latest is that it will come back to operations probably tomorrow. So it's really close for the entire day. And what we know is that there was a substation, a power station that went out overnight, just before midnight. The fire brigades were called in around then, and they battled the blaze. That's out now. That's extinguished. But the problem continues, and they have no service at Heathrow whatsoever. So it's really ground to a halt, which is really quite unprecedented. We've not seen this kind of a disruption previously. There have been cases where, fog might have been a problem, or ice, or just generally bad weather, or strikes, or some sort of a technical outage. That usually lasts a couple of hours, but for the airport to properly shut down for a full day, that is unprecedented.
Well, Benedict, let's put some numbers around this, right? 1,400 flights, some 200,000 passengers each and every day. That's what Heathrow's handling. I mean, but I'm hearing about flights that were in midair, like over the Middle East or Asia, that had to turn around and go back. I mean, talk to us about those passengers. Like, what happens to them?
So, yeah, you're absolutely right. So if you were lucky, you managed to land somewhere in the UK, not at Heathrow, not in London, but maybe Gatwick, which is nearby, maybe Birmingham, which is to the north of London. So at least you're in the right country. But there were some aircraft that were already en route. For instance, there was one from Etihad, which is from Abu Dhabi in the Middle East. They had to land in Frankfurt. So if you're trying to land in Heathrow, you think you're landing in Heathrow, but you're in Frankfurt in Germany, that's a real problem. Hundreds of people on the ground in the wrong location. So the airline will then need to tend to these people. They might need to put them up for the night. It'll take a while for them to get them to the final destination. This is expensive. It's cumbersome. So really quite a lot of disruption. We have a nice map in our latest story now that sort of shows the diversions, that shows a lot of aircraft over the US turning back. So annoying, but at least lucky that you end up where you started off and you're not in some place where you hoped you wouldn't be.
Benedict, a lot of folks are asking the question, why isn't there a backup power source for such a critical piece of infrastructure? Do we know anything there?
We don't at this point, but that's obviously one of the big questions that will be asked and is already being asked. And also, what was the cause of this? So far, nobody has said it was sabotage, but obviously that's also one area that is being explored. Europe is quite jittery when it comes to any kind of outages that are unexplained. In the UK, Keir Starmer, the Prime Minister, has come out and said he's being sort of kept abreast of what's going on. So it's too soon to say what it was, but the counterterrorism units are looking at this. The police is investigating. It could well be that it was just some switch that conked out and led to a mass failure, but it could be something more sinister. We don't know at this point. But it is obviously a big question. How could it be that one power station, regardless how big it was, would take out the entire airport? What were the redundancies? You have to remember the aviation industry is generally built around sort of safety and redundancy. So every aircraft has 2 or 3 systems that sort of kick in if one thing goes wrong. On the ground, similar. So why didn't it happen this time? That will raise some questions about sort of the robustness of the Heathrow system. This is an airport that is critical to UK infrastructure, European infrastructure even. So you'd think that they'd have that sorted out, and the fact that they didn't, that's quite a sort of black eye on the UK.
Benedict, thank you so much for your reporting. Benedict Camel, global aviation editorial leader for Bloomberg News, and that is the story of the day.
It definitely is.
I think about my little Generac generator in the backyard that got me through Superstorm Sandy, and I can't imagine a giant piece of infrastructure like Heathrow wouldn't have something.
Well, Paul, it begs the question, who's to blame? And it just takes me back to what we asked Guy Johnson earlier. Who is to blame if I'm the insurance appraiser and I'm trying to, collect money or pay, and somebody's coming to me to get paid? I mean, I need to know who's to blame here, and I don't think we have any answers yet.
No, I don't. But again, the cause is also another big issue. You'd love to rule out anything nefarious, as Benedict was suggesting, but we just don't know. So hopefully we'll have some news coming out of some of the authorities in London soon. We've got Guy Johnson. We'll talk to him from Bloomberg Television. He's at Heathrow. We'll hear from him several times during the show to get the latest reporting. So that is a good thing. S&P futures minus 18, Dow off 141, NASDAQ off 85. We'll have more coming up. This is Bloomberg Surveillance. Good morning.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
What's the immediate take of a tariff war?
For the longest time, technology has been the driver of this market.
With Lisa Mateo on markets.
AI affecting demand for cloud computing.
And Michael Barr with news.
Trump declared a national emergency at the U.S. border with Mexico.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, folks, we have Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney. John Tucker's with us as well with the news. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. That would be the internet, Damian, if you're aware of that.
Oh, yeah.
YouTube.com, search Bloomberg Podcast Live, and that's where you'll find us. Coming up, we're going to check in Karen Manna in our studio. How cool is that? Investment Director, Fixed Income at Federated Hermes. We're going to talk about this bond market here. Rema Serafi, Vice Chair, Tax at KPMG. Where's the tax plan for this country going forward? So we got a lot. We're going to talk about the markets. We're going to talk about the news, get the latest reporting coming out of Heathrow as well. So a lot to keep us busy here. Futures a little bit negative here, 90 minutes before the open. We'll stay on top of the markets. Got some earnings as well. Let's kick things off this hour with a Bloomberg Business Flash with John Tucker.
All right, expiration of options today, so you can bet for volatility. Volatility, the word of the day, options contracts worth about $4.5 trillion. They're going to head for expiration. S&P 500's rebound from last week's low hasn't been entirely convincing. The last 4 closes coming in well above the high of the day. Right now, futures point to a lower cash open, well below the high of the day, I should say. Lockheed Martin, those shares right now, they are higher after Bloomberg reported the White House poised to announce today the winner of its contest to build the next generation fighter jet. They'll have to choose between Lockheed Martin and Boeing. Elon Musk seeking to reassure Tesla employees that despite rocky moments, they should hang on to their stocks. Tesla among the most actively traded, right now up about 0.7%. Nvidia, the most active pre-market, that is down right now 0.4%. After their earnings, Nike shares down about 7%, and then you have FedEx shares. Those after their earnings also down just about 7%. And hey Siri, who's the new boss? Apple shaking up the executive ranks to get its artificial intelligence efforts back on track after months of delays as well as stumbles. Apple shares right now down about 0.9%. Overall, the Dow futures point to a lower cash open, down 115 points. The S&P E-mini futures right now, they are down 14 points. The NASDAQ futures down 62 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Damian and Paul.
JT, thank you so much. Appreciate that. Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City in the congestion pricing zone, as John Tucker will tell you. We're also streaming live on YouTube as well. I think that probably the term we've used more in the last 2 months than we've ever used before is uncertainty.
Uncertainty.
And, just policy coming out of D.C. Where are we going with some of these trade policy issues? And it's certainly been an issue for investors, financial markets broadly defined, including fixed income markets. Let's talk about that now. Karen Manna, Investment Director, Fixed Income, Federated Hermes, Pittsburgh, Pennsylvania. The pride, she's a graduate of Penn State University. I'm a monster fan of Penn State. My son graduated from there, great school. Karen, thanks so much for joining us here. What do you tell your clients these days when they seemingly are getting whipsawed every day by news events as opposed to maybe some fundamentals of the bonds they do own?
Good morning, and thank you for having me. It's a real pleasure to be here in studio with you. So uncertainty is deeply uncomfortable, and Treasury markets have been misbehaving, perhaps, swinging in a volatile way, which is not what's desired by fixed income investors at all. So we say, realize that the uncertainty will be resolved when those in the administration resolve it, but position in a way that highlights a couple of things. First and foremost, liquid instruments. Be cognizant of your liquidity so that you can be nimble and position yourself appropriately when we're not doing scenario analysis, but we have actual facts to deal with. Stay up in quality. And for newer money, we like the idea of shorter duration, 1 to 3 years. Pick your flavor there. Multi-sector gives the portfolio manager a little more opportunity to add value to your portfolio. But so basically stay short, stay high quality, stay in liquid instruments.
Well, Karen, I mean, you're the investment director of fixed income at Federated Hermes, and I have to ask you this. How much time are you spending looking at the foreign exchange markets? The broad dollar index is down 3% year to date. I mean, forget about it. I mean, it's non-dollar denominated debt like my emerging market local currency debt, which is leading the way up 5% year to date. Talk to us about the role emerging markets, or for that matter, non-dollar denominated developed market debt plays in a broad fixed income portfolio.
It most definitely has a role, and a role now that is worth consideration. EM markets have withstood the tests of inflation and all the shifts over the past couple of years. And we saw a dramatic tightening in spreads last year that we were able to take advantage of. And then we, in our portfolios, moved back to a more neutral stance. But within EM, what you've highlighted is that you have different ways to invest in the markets: the currency, the sovereign debt, the local currency corporate debt. And that gives the portfolio manager some latitude. So it's an area that we like. But you also highlight the shift to international. And what does that mean for US dollar domestic-based fixed income? That's a different landscape, playing field, whatever you want to call it, than we've had for a very long time.
I'm looking at the INGO function on the Bloomberg terminal, the Bloomberg Index browser. The best performance in fixed income in the U.S. has been U.S. mortgage-backed securities. Talk to us about that market, how you guys view that.
We are overweight to mortgage-backed securities. We see that as a strong positive, and we've been there for a very long while. You have a situation with mortgage-backed securities where you had two of the largest buyers step back, creating a technical opportunity. And that was the Fed, as they've pared back their balance sheet, and then the U.S. banks. So mortgage-backed securities, the second largest market in fixed income behind U.S. Treasuries, a buying opportunity for us, and one that we think will persist for a while longer.
And Karen, does that extend? I mean, residential MBS, we're talking, not CMBS, but let's talk about ABS. Let's talk about some of these other more complicated securitized asset classes. A lot of them are short duration. I mean, what are your thoughts there? I mean, where do you think we should position along the curve? And does that kind of filter through into your, your willingness to want to invest in, say, asset backs versus mortgages?
In our shorter duration strategies and approaches, we are using asset-backed securities to a great extent. Our asset-backed team that is also in charge of those short duration portfolios has an affinity for those types of instruments and sees value. At the short end, as you point out, they are short duration, not long-term maturity. They offer more value than similarly rated corporate bonds. So an attractive space for the markets, but one that has simply grown. Right? When we came from the depths of the financial crisis and then to their most recent conference in Las Vegas, huge interest in that segment of the market because of the yield that can be created.
Yeah, it's not just student loans, credit card receivables, and auto loan floor plans anymore, I guess, right? In that spectrum, what other sort of non-traditional asset classes, subsectors of that ABS world are you investing in?
We tend to stick to the more defensive elements, what you might call the plain vanilla areas of that market, the more receivables, but we're watching with interest what goes on with that market. We have other areas within alternatives that are short duration and floating that we employ in our portfolios, and that's namely trade finance.
So we like municipal bonds on this show. Actually, it's Municipal Bond Friday. We have a sponsored segment later this morning. Talk just about the municipal segment.
Well, municipals are always near and dear to my heart. It's where I started in the industry as an analyst. Public power and electric utilities were my bread and butter for many, many years. But munis offer nice stability for portfolios. The credit quality is very, very solid. We've seen a walk back in spreads a little bit this year, some dislocation in the market because we've seen a tremendous amount of supply. Year to date, muni supply through early March is up 24%. So you're seeing issuers trying to position, get out in front of a couple of things, right? Move early rather than later. But the credit quality is there. And I think right now, investors are seeking that income protection because it's fairly simple. You're getting more income in your portfolio and you want to protect it to the greatest extent possible.
Well, Paul, Karen makes a great point. A lot of that muni supply year to date has been universities and colleges. So the tax change, the law, the legal changes that are happening. Columbia with the Trump administration is driving a lot of these universities to tap the municipal bond market here. And my question, and we should be asking Rema Serafi this, who's the vice chair of tax at KPMG in a minute, is how much of that, is really, do you want to own in your portfolio? We mentioned ABS, we talk about student loans, we can talk about all of that. Just how much exposure do we want to have to that element, to that end of the market here, Karen?
Well, specifically munis, tax-exempt investing for universities, that's an area where you could see some credit issues, even setting aside tax policy. We all know that there's fewer people going to university simply because of age wave and challenges and cost. So we have a number of universities that likely, even if you look through the sector to just the underlying financial statements, wouldn't pass credit muster because of how they're positioned. So that's an area where we do have less exposure or would be underweight in our muni or tax-exempt portportfolios.
Karen, thank you so much for joining us. Really appreciate you coming in, particularly on a Friday. Get a double gold star on a Friday. I'm looking around here. It's ridiculous. Karen Manna, Investment Director, Fixed Income, Federated Hermes, joining us here in our studio. Let's stay on the tax thing. I got my taxes back from my dude yesterday. I had a number in mind, well above my number in mind. It was like, geez, I'm writing that check 11:59 on April 15th.
I'm filing an extension, Paul. I didn't have the time. It's been so busy this year. I haven't really had the time to sit down and go through it all. So, I already filed an extension. It's terrible. I hate doing it.
Brutal. So, anywho, let's talk taxes because I don't know what's happening when taxes come out of this administration. And I think a lot of investors are also a little bit uncertain about the tax situation and the strategies of this administration. I think the expectations were for a positive scenario, but we're just not sure. Rema Serafi, she gets paid to think about this stuff. She's the vice chair, head of tax at KPMG. Rema, what are you telling your clients about how the tax structure in the United States is likely to evolve over the next 1, 2, 3 years?
Well, thanks for having me today. It's a pleasure. So it's a really busy and exciting time to be in tax. And KPMG is looking at what we call the tax policy trifecta right now. There are three things happening at once. One is the 2025 tax cliff, which is set to expire at the end of this year. The second is global reform. And the third is any other regulations that are changing on the horizon, including the impact of President Trump's tariffs. So our clients are looking at the confluence of all three of those things, which are huge disruptors to their business.
So talk to us. What are you hearing from your clients here, Rema? What is the number one issue? Is it the tariffs? Is it potential tax changes from the Trump administration? What are you getting queried on most?
We're getting queried on all of the above. And that's what's super interesting and exciting right now because they're all happening at once. So because it's multidimensional, we need to model, our clients need to model scenarios for both the short, medium, and long term. And that's what our platform, Digital Gateway, has the ability to take data and put it in one location and be able to model those scenarios at one time and be able to pivot based on, as you know, the daily changes that are happening in the market and with regulatory change. So our clients are basically talking to us about all of those things depending on their facts and circumstances.
So how do you think this tax cut discussion, this negotiation in Congress will go? It's my understanding that they can't do anything until they pass a budget here. So I'm not sure how this is going to play out. What are you advising your clients?
You're absolutely right. No one's sure how this is going to play out, right? The hardest part of passing this bill still lies ahead. We need both chambers of Congress to agree on the provisions of the bill, and that's the hardest part. So it lies ahead. We don't know, and that creates even more uncertainty. And one of the things we're advising our clients, among many things, is to not wait and see. Our clients really need to get after this now and be able to model out the scenarios. Because once legislation starts to become clearer, things are going to move really fast, and companies are going to need to be able to react to a bill. So while it's not certain when it will happen, it probably will. It's just the hardest part lies ahead.
Rema, all my wealthy friends up in New Canaan and Greenwich, Connecticut are worried. They're hedge fund managers, they're private equity managers. They're worried about the carried interest here. I mean, talk to us a little bit about your thoughts there. What are you advising clients on that end?
Yeah, so again, there's so many dimensions to this that have yet to be seen. And like I said, the big picture here is that companies need to, and individuals really need to look at the impact of all the dimensions of the changes. And really time will tell what all the various specific questions are that individuals and companies have related to any impending bills.
Rema, outside of the U.S., what are kind of the key issues that you guys are facing here for your global clients?
So our global clients are facing into that second prong of the tax policy trifecta that I talked about, global reform, which is the impact of Pillar 2, among other things. So BEPS, I'm sure you've heard about it. And so what are the impacts outside the U.S., even though the Trump administration has indicated that it's not going to be amenable to BEPS Pillar 2? Companies that operate outside the U.S. still need to comply with Pillar 2 regulations that are in place in the countries in which they operate. So we're advising our clients on their global footprint and looking at what tax planning or what operational changes they need to make in light of that uncertainty as well.
Rema, I know KPMG is the first of the big four to be licensed to practice law here in the U.S. What's the motivation behind that?
Yeah, so KPMG is really proud to be the first of the big four, KPMG Law US, to provide what is really an increasing need in the legal market space today, which is providing process-driven, technology-enabled services for our clients. And that is a real growing need. The volume of transactions, the volume of contracts that need to be managed, the ability to put that on one technology platform, which I talked about, our digital gateway platform, is really important in the marketplace and being validated by our clients. So that's what we are going to do, and we're already getting tremendous receptivity in the market for that need.
Rema, thank you so much for joining us. Rema Serafi, Vice Chair for the tax practice at KPMG, the Big Four. I remember when they're the Big Eight.
Oh, my God, yeah.
And then the Big Six, and now we're down to the Big Four. With our news in New York City, Michael Barr.
Thank you very much, Paul, Damian, John. London's Heathrow Airport is closed all day today due to a power outage caused by a nearby fire, affecting over 1,300 flights and hundreds of thousands of passengers. The airport's closure is likely to continue for days, with significant disruptions expected, and airlines are working to update passengers on their travel options. This man was supposed to catch a flight back home to Nashville, Tennessee.
I think I'll take the day. I don't know. Maybe I'll do something, maybe I'll go explore somewhere. I don't know. I'm going to try to make the best of it.
The incident raises questions about the robustness of Heathrow's infrastructure and its ability to handle such disruptions, with an investigation underway to determine the cause of the fire. President Trump signed an executive order to largely dismantle the education department. Bloomberg's Amy Morris reports from Washington.
Trump has directed Education Secretary Linda McMahon to facilitate the department's closure. The move aims to transfer the department's functions to states and other federal agencies, with Trump vowing to preserve programs like funding for students with disabilities and Pell Grants.
They're going to be preserved in full and redistributed to various other agencies and departments.
The plan faces legal and logistical hurdles, with concerns about the impact on student loans and grants, as well as potential clashes with labor unions and lawmakers. In Washington, Amy Morris, Bloomberg Radio.
President Trump has signed an executive order to boost the U.S.'s ability to produce critical minerals, potentially including coal, to reduce reliance on foreign imports. The order will provide financing, loans, and investment support to domestically process critical minerals and rare earth elements. The move is in response to concerns that China controls the processing of critical minerals, which are used in products like batteries and defense systems. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Damian, and John.
Michael Barr, thank you so much. We appreciate that. Damian, we've got the S&P off, 7%. People, and we were down peak to trough 10%. People were getting a little bit dicey. The VIX was in the mid-20s. Yet Bank of America is out with a really interesting report. Investors are dismissing the risk that a full-fledged trade war would pose to stocks as a monster inflows of capital keep pouring into global equity markets. You can't keep this investor base down, it seems like.
Yeah, people just want to buy up this market. I mean, look, I think the real thing here has been growth expectations in the U.S. If you look at U.S. real yields, I mean, okay, fine. We've seen them come in. I think the 10-year real yield's at 190. But my goodness, Paul, if you look at, the real yield on the 2-year, it's off like 150, 160 basis points to like 0.75%. I mean, that's what growth expectations look like now here in the U.S. And I mean, can the equity market keep up? Can it remain resilient in the face of that? Your guess is as good as mine.
They're out. And Merrill Lynch is again out with this really cool chart. And I tell you, I'm going to say Merrill Lynch. Bank of America, I'm old school. They're calling Merrill Lynch. But Bank of America, Merrill Lynch, they have some really good research in terms of where the fund flows are going. They come out with that on a weekly basis. They're having the chart there. U.S. tariffs on the world set to jump from 2 to 3% to north of 10%. That's got to impact global growth to some extent. I think that's kind of what the markets are reflecting. Yet, as they note in their research, investors keep throwing money at the markets.
And I mean, just look at the performance of the Canadian dollar, right? Because they were the first ones to take it on the chin, right? I think the cumulative impact of the tariffs so far have been 3.5% on Canada. And you see it's the worst performer among G10. I mean, it's barely up versus the dollar this year, whereas the whole world is up versus the dollar this year, Paul.
Exactly right. So, and again, I always keep an eye on the euro for Tom Keene because, he's got to be in his Paris cafes, his Rome cafes and restaurants. He wants parity. We're sitting there 1.085 on the euro. So we keep an eye on that for Tom Keene. Futures in the red here this morning. S&P down 17, the Dow down 134, and NASDAQ down 78 points. It's about 0.4%. Gold pulling back a little bit. We were 3,040 per ounce. So it's had a phenomenal push higher. That Goldman Sachs 3100 call looks pretty darn good. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker on the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. The offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. So the latest earnings reports kind of setting the tone this morning. Not great. FedEx shares, they're lower pre-market. They were down about 7% right now. The company lowering the full-year guidance for third quarter, for the third consecutive quarter. They're citing inflation and uncertain demand for shipments. And then you have Nike, that was also down right now about 7.4%. They expect revenue and profitability to decline further, with the gross margin dropping sharply in the current quarter. Johnson & Johnson, I said today, New Brunswick, New Jersey-based Johnson & Johnson.
Johnson & Polana, great golf course. Former Johnson State.
It all comes back to golf for Paul. They're going to invest more than $55 billion within the U.S. over the next 4 years, including 4 new manufacturing plants. One of them is going to be in North Carolina. The locations for the other 3 not yet disclosed. Right now, the Dow futures down 133 points. That's a decline of 0.3%. The S&P E-mini futures 17 points lower, and the Nasdaq futures right now down 78 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Damian and
So just
Paul.
to finish my golf thing, the Johnson & Polana, that was the estate that the Johnson family lived on in Princeton, New Jersey. They've now converted into a golf course, a TPC golf course. It's phenomenal. And the clubhouse is the old Johnson family house. Extraordinary. It's open to the public. So, John, if you want to go down there and...
Even somebody like me can go there?
Even somebody like you can go down there, stick a peg in the ground and have some fun here. The story of the day, and John Tucker, thank you so much. It's got Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. The story of the day, top on the Bloomberg terminals. London Heathrow Airport shut after fire in worst disruption in years. We've been fortunate to have access to Guy Johnson, Bloomberg television host. He is at Heathrow Airport. Guy, thanks so much for taking some time again here to chat with us here. Any latest reporting coming out of Heathrow as it relates to how long these disruptions may last?
There has been some suggestion over the last hour or so that maybe actually power will be restored over the next couple of hours. But actually, in reality, Heathrow will certainly remain closed until midnight tonight. You can't even get in here right now. The police have basically closed the whole airport off, so you can't even drive to the terminal. There's 5 terminals here at Heathrow. They are all closed down. Terminal 5, which is the newest and the one that is operated by British Airways, actually is on a separate power grid. So it is powered at this point, but all the other terminals don't have any power. Nothing's coming in, nothing's going out. All the flights in and out of Heathrow have been cancelled. So we don't know at this point when we're going to be reopening. Even if we reopen a little bit later, the chaos from this shutdown is going to last certainly throughout the weekend and probably until early next week. You've got aircraft out of position, you've got passengers out of position, you've got crews out of position. Bringing that all back into line is going to take a few days, regardless of whether or not we see power being restored over the next few hours.
Guy, you mentioned that all these passengers, that the airport's closed. So, I mean, where do these passengers go? I mean, are there hotels in the area? I mean, are there motels, hotels? I mean, talk to us a little bit about,
So, look, I'm standing behind me. What you've got is the kind of the tunnel that takes you down into Terminal 1, 2, and 3 here at Heathrow. Opposite, I can see there's a series of hotels that are on the kind of perimeter road. I've been into a couple of them already this morning to grab a coffee. There's passengers sitting around. They don't know what to do. There's a distinct lack of information from some carriers. They're trying to figure out what exactly is going on. So at the moment, everybody's just in limbo. We are seeing certain airlines already cancelling and giving refunds to passengers, basically saying you can rebook if you want to. Some are trying to get onto flights over the next few days. That's proving to be very difficult, I understand. It's not a clear process as to how this is going to unfold. So yeah, I think there's a lot of passengers in limbo, not only here at Heathrow, but around the world. JFK and lots of the other busy airports which link into Heathrow around the world are going to be seeing something similar as well. We just don't know at this point how long it's going to take to clear this through.
Guy, thank you so much for your reporting. Really appreciate that. Guy Johnson, host of Bloomberg Television. He is at Heathrow Airport today, giving us boots on the ground reporting there. I have this Flight Radar 24 app on my phone where you can see where planes are going and you always see this monster traffic going in and coming out of Heathrow.
Yeah,
it stopped.
The black hole.
That's a black. It's just a crazy story, and there's so many questions still to be answered there. Guy Johnson's on the ground, and he'll get it for us. Bloomberg Surveillance today, brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control over their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn more. Let's talk about the global supply chains in a world of rising tariffs. What does it mean for trade here in this part of the world and around the world? Alisa Rusanoff joins us. She's the CEO of Eltech. She joins us here in our Bloomberg Interactive Broker studio, which gets her double stars because it's a Friday being in our studio. Alisa, thank you so much for joining us. What are you telling your clients about tariffs and what the ultimate impact will be on trade between the U.S., Canada, U.S. and Mexico, the North American in general? What are you telling your clients these days?
Yeah, so pleasure to be here. There is a lot of volatility, obviously, in the markets, but I'm finance and trade, so there's a lot of cross-border trade that I'm seeing on my side, whether it's Mexico, Canada, or other parts of the world. And obviously, there is a lot of uncertainty happening, and a lot of suppliers, small suppliers in Mexico, in Canada, bigger corporations, and specific sectors that are really impacted by it. So I finance a lot of industry related to cars, car parts, energy, commodities like coffee, which I'm a big consumer of, obviously, being in New York, a true New Yorker. So there's certainly a lot of volatility in that sense, meaning if you're looking, for example, at the car parts or just car export/import trade, that's a crazy amount of operational volume, because it's not just a car is being, let's say, manufactured in Mexico, just goes into the U.S. and you can just put a tariff on it. The reality is the car parts go back and forth, maybe 3, 4, 5, 6 times. Wow. That's absolutely right. There's a lot of operational logistics there, because apparently shipping is actually quite cheaper than manufacturing in certain regions. So reciprocal tariffs do not necessarily make sense, even from an operational standpoint. It's just really, really hard to do. And unfortunately, trade is not necessarily digitized. So operationally, you have to have tremendous amount of staff on the U.S. border or Mexican border, Canadian border, to really be able to do all that. And then if we're looking at the car sector, if, for example, we will impose 15 to 20% tariff on Canada and Mexico, our car price will probably go up by 4 to 8K, right? So that's a lot that goes on the U.S. consumer, obviously. So, and that impacts a lot of other jobs, not just the consumer that obviously is an inflationary matrix, but it also affects a lot of jobs, because we have a few largest ports in the world, whether it's New York, New Jersey, California, Pennsylvania, etc.
Alisa, I love, and Paul, I love trade finance as a strategy. It's been around for so long. It's been a cash cow. I mean, historically speaking, and please, Alisa, correct me if I'm wrong, high single digit, low double digit, very smooth, returns over time. Can we, as an investor, still expect those same types of returns? I mean, I love asset classes that are complex and structured where you can engineer performance. Is that still the case in trade finance?
That's absolutely right. Not just you, but my investors like that a lot. So I've been financing for over a decade now. It's very true. It's a very liquid market. There's a lot of volume. There's a lot of various types of supply chains and gaps where financing is needed, whether it's on the supplier side or on the customer side, which is called receivable financing or factoring. So there are different structures you can create to actually finance a trade. And there's a lot of cross-border trading, obviously, because we still live in the globalized economy, globalized world. So everything that we're seeing in front of us right now probably is coming from other countries in certain supply chain factors of it. But in terms of volume of it, if the tariffs do occur and they are imposed, so I would expect the volume to go down. And we've had it last year, right? Sometimes we just have to go back in history, and we can look at Smoot-Hawley Act or law in 1930, and the global trade back then went down by 60+%, right? So it impacts the U.S. economy, it impacts the global economy. And I guess investors are very still interested in the trade finance, but we're just concerned about the volume of it.
And just 30 seconds left. April 2nd, is that a big date for you?
Yes, I'm having a lot of coffee. That's coming from Brazil or Colombia.
Okay, right, and so subject to tariffs. Alisa Rusanoff, thank you so much for joining us. Alisa is the CEO of Eltech, talking about trade finance in a world where trade is coming under some pressure with all the the new potential policies coming out of this White House.
Well, I wish we had more time because I'd love to ask Alisa about insurance, because insurance costs on all this have been exploding to the upside, right? Wildfires, hurricanes, and the like. And, I'm just curious to hear what that impact has. We'll get her back on here soon.
Yeah, we'll talk trade finance anytime. Alisa, appreciate it.
Got to do it.
That is, we'll come back on that. S&P 500 futures, we are off 23 points. That's about 0.4%. The Nasdaq's off about 100 points, 0.5%. So a little bit of a pickup in the sell-off here. 10-year Treasury yields 4.21%. Gold holding steady, $3,040 an ounce. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. This on a day when the futures indicate a lower cash open on Wall Street. Markets haven't finished a week with gains since the middle of last month, so if things don't turn around today, it'll be their fifth straight losing week. And do expect volatility. You have $4.5 trillion, that's with a T, dollars worth of options expiring today. You either exercise the option to buy or sell at the strike price or let them expire. FedEx tumbling right now, over 7% pre-market trading. They cut the earnings forecast. Inflation, uncertain demand for shipments squeezing the company's bottom line. And they have Nike also sliding just about the same. It signaled declines in profitability. We'll take a deeper dive coming up in a few minutes into these stocks. Right now, the Dow futures 237 points lower. That's down about 0.6%. The S&P E-mini futures 37 points lower. That's down 0.7%. NASDAQ futures 163 points lower, and that is down 0.8%. Yields real quick. In the yield space, 2 years, they are down 4 basis points, 392 there. The 10-year, that is down 3 basis points. That is at 420. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Damian Paul.
All right, John Tucker, thank you so much. We appreciate that. Damian Sassower sitting in for Tom Keene this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We are streaming live on YouTube as well. Markets over the past 2.5 months have been trying to deal with a level of uncertainty that has been a little disconcerting as they try to figure out economic policy coming out of Washington, D.C. We're going to take a look at one of those markets, commercial real estate market. We can do that with Linda Pendergast. She's Executive Director, Commercial Real Estate Finance Council, joining us right now. Lisa, talk to us a little bit about kind of what you're seeing in the world of commercial real estate. And again, as I said earlier, I know it's a diverse type of marketplace, lots of different subsectors. But generally speaking, how is the commercial real estate business doing these days?
I think we're doing fine when you look at things like loan performance and the volume of issuance in the commercial mortgage-backed securities market. And also what banks are doing. So it's fairly vibrant. I do think there are concerns on the horizon. Certainly the potential for an economic slowdown and rising inflation are not going to be helpful to commercial real estate assets and commercial real estate finance. We know inflation has kind of come down, and yet it's still very readily obvious in services and housing and energy and the like. For us, it's not a significant concern yet, but the potential impacts of tariffs and global trade wars isn't promising, and it suggests that will drive inflation higher. And that's meaningful to us because it also then usually is accompanied by an increase in rates. To the extent that a lot of these loans that are maturing, and there are a significant amount of these loans, billions of these loans that are going to mature. Just to give you a stat, in 2025, some $957 billion in commercial real estate loans will mature. The problem with that is that most of those loans were originated at coupons at around 2.5% to 4.5%, and currently you're looking at something more like the 5 to 6 to 7% area. So in that situation, you would have to have borrowers either put in additional monies, or you're going to see some distress as those who can't do that, right, are going to have problems refinancing. And as I said, that significant 957 billion number scares me a bit, because it does mean, that you're going to either have to work with lenders, and I do think to a certain extent, some of these new debt funds and the like are going to be able to assist in avoiding certain loans going into foreclosure and to prevent distress. And they'll do that by AB note splits, modifying terms.
Right.
Some of these alt lenders stepping in to provide bridge financing.
Lisa, I was at Crescendo Miami in February, and
What?
it was Crescendo Miami. Crescendo, that's the CRE Finance Council that
Thank
Lisa.
you.
Yeah, thank you.
Nice.
It's Crescendo. So the Crescendo Miami in February was packed, Paul. It was packed. And
What's
I heard
Miami?
ABS West, which is in Vegas. That's the SFA's event. On commercial real estate, packed, like the biggest ever. And yet I'm looking at the CREFC Board of Governors Sentiment Index, and it is, I think in Q4 is at an all-time high. I mean, Lisa, where are we here? Where is sentiment for commercial real estate finance for CMBS writ large right now?
I mean, it's exactly where you read about. So to the extent that I do think there's a certain sense that folks are doing the right thing as it relates to loans that are struggling to sort of refinance. Oftentimes what you're seeing in some of these large single asset, single borrower CMBS transactions is that, certain borrowers are getting extensions, and clearly the asset needs to be performing well, the borrower needs to be performing well. But if all that's true, they are extending these loans such that, wait for a better time, wait for rates to start to rally a bit and to fall. And therefore they be able to refinance. Most of these SASB deals, are performing reasonably well. Clearly, the office SASB we keep an eye on to make sure that's certainly
John Gray Blackstone office single asset single bill. Yeah, absolutely. I mean, look, the other hot area I know that CREFC's been looking at are data centers, right? And I know you just had an event not long ago where you basically were talking about just the market. It's grown so fantastically, in such a short period of time. And here we are after DeepSeek. I'm just wondering if the narrative has changed at all. Have you what's the vibe there? What's sentiment like in data center land?
Data center land, yes. There's a lot going on in data center land. And I do think that is, it is sort of the new shiny toy, if you will. But I think it has legs. Certainly there are concerns regarding energy and issues like that as it relates to data centers. The cost of building and maintaining those centers is significant, but it is an asset class that is growing within the commercial real estate market. We're seeing a lot of these single assets, single borrowers, CMBS transactions backed by data center, either generally portfolios of data centers. So to the extent that I don't anticipate that that's going to go away anytime soon, you have to be somewhat concerned about the technology and how that moves, and can it move fast enough to keep up with the demand? Are there, sort of more ESG issues associated, environmental issues in particular, that you might be concerned about as you continue to build these centers across the country?
Lisa,
what regulations might arise?
All right, Lisa, thank you so much for joining us. Really appreciate getting that update there. Lisa Pendergast, she's the executive director for the Commercial Real Estate Finance Council, or as the kids call it, CREFC. There you go. Learned something new today. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Damian, and John. This is what you'll hear when you call British Airways customer service out of London's Heathrow Airport.
We're taking lots more calls than usual and won't be able to put you through to the team right now. We're really sorry about that, but please try us again later.
The Have a Nice Day response is because of a large fire near Heathrow that knocked out power to Europe's busiest flight hub and forced it to shut all day. It is disrupting global travel for hundreds of thousands of passengers today. More than 1,300 flights to and from Heathrow have been affected. Bloomberg's Benedict Camel.
Really an unprecedented step. We've seen outages in the past that have lasted a couple of hours, maybe half a day. But for the airport to be utterly unoperational for an entire day, that really hasn't been seen previously.
Bloomberg's Benedict Campbell. No word yet on what caused the fire. Israel's top court has ordered a temporary halt to Prime Minister Benjamin Netanyahu's dismissal of the country's domestic security chief until his appeal can be heard. The Supreme Court's decision came hours after Netanyahu's cabinet unanimously approved his request to fire the head of the Shin Bet International Security Service, Ronen Bar. The court said today it was delaying the firing until an appeal could be heard no later than April 8th. Earlier today, Israel's defense minister ordered the military to take additional parts of the Gaza Strip and vowed to hold them until Hamas releases the remaining hostages it holds. Some parents say that they are worried about President Trump's order to dismantle the Department of Education. But the president says core functions and things like Pell Grants are staying. And Republican lawmakers like Indiana Governor Mike Braun say it's better for states to be in charge of education instead of the federal government.
We're going to have those same metrics, that same accountability, but devised in a way that makes sense and that is actually producing results.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Damian, John.
All right, John, Michael Barr, thank you so much. We appreciate that. If I were trying to get out of England, I think I'd hop on the train, go through the Channel, get to Paris, and try to go from there.
Paul, do you know how long Michael Barr had to wait on hold to get that recording from Heathrow? He's been on hold for like the last 30 minutes.
Exactly. I'm sure. I don't think that's going to work for most of the people that are trying to get.
Is he planning traveling or something?
Thank Charlie Pellet. You know that's the travel guy. That's where we got the tape from.
Well, he's probably figuring out some kind of deal somewhere that he can take advantage of this. And Charlie Pellet on $10 a day, that kind of thing. So, all right, we'll stay on top of that. Heathrow story. We have Guy Johnson, Bloomberg television anchor. He is at Heathrow as we speak. So when news breaks there, when it develops there, we'll have it for you. S&P 500 off 38 points in the futures market. The NASDAQ off 170 here. That's about 0.8%. So we're seeing a pickup in the solid fears as we get closer to the cash open. This is Bloomberg. Good morning.
You're listening to Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
All right, Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney, live here at Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast Live, and that's how you'll find us. Let's take a look at some stocks on the move today. We do that with Bloomberg's John Tucker. John, what do you got?
Let's start with an overseas stock, guys, that's taken a hit, and you'll know why. It's IAG, and they own British Airways.
Oh, yeah.
And the home of British Airways, of course, is Heathrow Airport. BA says in a statement, the shutdown at Heathrow from that electrical outage is going to, quote, clearly have a significant impact on our operation and our customers. And we're working as quickly as possible to update them on the travel options for the next 24 hours and beyond. About 677 flights affected by British Airways. British Airways alone. That doesn't count the 62 for Virgin and 42, at least 42 for Deutsche Lufthansa. By the way, it brings up the question, and put on your thinking cap, what are the busiest airports in the world? And rank them. Do you know?
Well, Dubai's got to be up there.
Atlanta.
Singapore?
Atlanta's number one, followed by, yes, Dubai, Tokyo, Heathrow. Heathrow's number 4.
Wow.
And then Dallas, Fort Worth, and then Denver. which is kind of surprising. I guess in the New York metropolitan area, JFK doesn't rank way up there because we've got JFK, Newark, and
put all those
LaGuardia.
three together. I'm sure.
But yeah.
Okay. What else?
Next one. This is kind of obvious, and it's the earnings from FedEx lowering the full year guidance for a third consecutive quarter. So they say the adjusted earnings are now expected to be in the range of $18 to $18.60 per share this fiscal year. So what's the big deal? They're blaming inflation and uncertain demand. FedEx, the latest company in the U.S. to sound the alarm amid weakening consumer confidence and the potential fallout from President Trump's escalating trade war. They make a lot of this stuff over the border. The company's always been considered something of a bellwether. Well, they ship a lot of stuff, of course, worldwide. Something of a bellwether because they're exposed to a big part of the global economy. Volumes also hit by the expiration of the contract to carry packages for the U.S. Postal Service. Now, Lee Glasgow at Bloomberg Intelligence covers the company. He says the tariff proposals, including one to revoke the so-called de minimis exemption for low-value shipments, have made package demand and profits especially difficult for FedEx to predict. I love this. He says, quote, they throw a number out there and just are hoping for the best at this point.
That is Lee Glasgow's cynicism at its best, which I love. That's one of the reasons I hired him. He doesn't take the company line.
All right, another earnings story. Nike, the comeback there looks like it just stumbled. The company signaling further declines in revenue and profitability. The company trying to clear out old inventory through heavy discounting. But inventory levels remain elevated across all categories, they say, and the gross margin expected to decline sharply in the current quarter. Demand's fading for some of the biggest sneaker franchises. Nike also cites a backdrop of weak consumer spending and fallout from the trade war. You got to wonder, like in past, when a lot of companies blame the weather or something like that, if that's going to fall under the category of the trade war as well.
It's easy. It's an
easy excuse. It might be legitimate, too. Up next, the ticker symbol MSGS. There are two because there's MSGS and MSGE.
The Dolan family has a control stock.
Madison Square Garden Sports. So after the Celtics, that's staggering, $6.1 billion sale.
right.
We asked the question, how does that impact the value of other NBA teams? And the Knicks were the only one that come close to being publicly traded. MSGS also covers the Rangers as well. So they're actually part of the Madison Square Garden Sports. The shares jumped. The trading volume also surged on that news.
Well, it's got an enterprise value of $5.7 billion, MSG. And that's got to be way higher than the Celtics because, A, it's New York, and B, you get the building, the world's most famous arena.
That's it. I mean, kudos to Wick Grosbeck and the team at Boston. I mean, they purchased that team in 2002 for $360 million, and now it's 6.1, 17x.
What's the most valuable sports franchise?
Cowboys.
Yeah, by far. That's like over $10 billion.
No question.
Yep. John Tucker, thank you so much for the stocks in the news. We will be back in a moment. This is Bloomberg Surveillance.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
The president wants lower interest rates from Chairman Powell.
You can make the argument that this is a really rich market.
With Lisa Mateo on markets.
Stocks are coming off another record high.
And Michael Barr with news.
President Trump signing a wide range of executive orders.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney. John Tucker is with us. Michael Barr as well. We are here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We're going to get to Margaret Brennan in just a moment, Face the Nation, see what they're going to be doing here this week. Jennifer Lawless, professor at the University of Virginia, is going to discuss the latest D.C. headlines, so we're going to get to that as well. Joanne Bianco, partner at Bond Blocks, why markets suggest to her that the Fed will make no moves in 2025 and hold rates steady. That is out of consensus call. So a lot to get to in this coming hour. We want to kick it off like we've been doing in each of the past 2 hours, giving you the latest reporting from Heathrow Airport. Again, the airport is closed for the day. A nearby fire knocked out power for a pretty wide area, including Heathrow. Guy Johnson, host at Bloomberg Television, is at Heathrow getting the latest reporting. Guy, what do you have for us right now?
Well, not much of an update since last time we spoke. To be honest, the airport remains closed. It's likely to be so for the next few hours. Even if power is restored, we are certainly likely to see the airport being closed until probably midnight London time tonight. So that's where we are. All of the 5 terminals are currently closed. You can't even get into them. The police are basically blocking all the roads. There is no access into the airport. So that's the situation we find ourselves with. We've got to get through the next few hours and understand kind of where we are. And I think this is the challenge that a lot of people are beginning to turn their thoughts to now, which is, even when the airport reopens again, how long is it going to take to get everything back on track? There were plenty of flights coming out of JFK overnight that had to be turned back. What's going to happen to those passengers? Those aircraft are going to be in the wrong place. What's going to happen to all the cargo and everything else that's trying to be moved around the world at this point in time? There's going to be a huge infrastructure and logistics snarl-up that will take a while to unravel, potentially 2 or 3 days.
Guy, all morning long we've been talking about, all the negatives surrounding this, as you mentioned. And, my question is, does anyone benefit from this? I mean, is there, is this a zero-sum game here, or is it just going to be an impact to growth, an impact to these companies, an impact to insurance costs, an impact to passengers? I mean, is there any good whatsoever to come out of this?
I struggle to find any, to be honest. I think if you're probably working in one of the hotels that sort of line the perimeter here, potentially maybe you're seeing some upside. But every time you see a large infrastructure outage like this, particularly when it comes to transport, you do get a really big negative economic shock coming off it, which can run into millions every day. 200-300 million every day could be the impact of what we're seeing here for the British economy, an economy that can barely afford to have anything like this happen right now. So no, Damian, I'm struggling to find the economic upside in all of this right now.
All right, Guy, thank you so much for your reporting. Really appreciate you having your reporting available to us. Guy Johnson, host, Bloomberg Television. He is at Heathrow. We'll have continued updates throughout the day. Let's get to Margaret Brennan. There is so much to talk about for Face the Nation, the CBS television network, Sunday morning, of course, CBS Radio, Bloomberg Radio on Sunday afternoon. Margaret, thanks so much for joining us here. We're getting closer and closer to April 2nd, which is going to be a big day for global trade as we talk about reciprocal tariffs. We have hot spots in Ukraine, in the Middle East. Where do you guys start?
I know there are so many targets right now. One of the places we will focus in are areas of resistance from fellow Republicans. They are so rare. Rand Paul is a libertarian, but within his party, he is one of the few Republicans who is really resisting publicly President Trump's tariff war. He's coming out against it. I'm sure the retaliatory tariffs against bourbon are persuasive to someone from his home state. But we want to talk to him about this, as well as why we're not hearing more from members of Congress in the House and Senate publicly about areas that Congress does control and yet is not resisting what the president is trying to do to bypass them when it comes to closures, whether it's of institutes, whether it's of entities like Radio Free Asia, the U.S. Institute for Peace, all these things that President Trump really seems to be testing in terms of how much he can expand executive power.
Margaret, I mean, we are hearing news that, Elon Musk was going to be briefed today about, the American military's contingency planning for a potential war with China. We know that Tesla has a huge operation in China. And, I mean, we just had Commerce Secretary Howard Lutnick saying buy Tesla stock. I mean,
I know.
You have to, I mean, is that illegal? I'm just like, how unethical, how immoral? I mean, talk to us about what's going on there.
We, on so many different fronts, are seeing testing of norms and testing of institutions, and in a way this time around where we're not yet seeing some of those institutions and norms pushing back. And that is different than the first Trump administration. In terms of the ethics of talking about a stock, I know the Commerce Secretary has gotten some scrutiny. Now, whether he's held to account or not for it may be up to the executive. As for, everything else, yes, for lawmakers, they are a co-equal branch of government. Why are we not hearing more from members of Congress? It's so interesting that when it comes to the vow to do away with the education department, we are hearing members of Congress say, hey, you can't do that without our consent because it's codified in law. On that, they are asking to weigh in. But there are so many other areas where those battles are not being fought. So there's an interesting shift or dynamic here. Even if ultimately members of Congress do agree with the president's initiative to try to do away with the education department, the acknowledgement by lawmakers that, oh, yeah, they do have a job, and in the Constitution they are co-equal branch, is new.
Yeah. So, Margaret, just switching gears just quickly to your area, your remit, which is foreign affairs, the State Department. What do you think the latest is coming out of Ukraine? How do you think that's going to play out over the coming days and weeks?
Well, we know that there will be technical talk Sunday and Monday between the U.S., Ukraine, and the U.S. and Russia, not all sitting down at the table together. We're still not at that kind of negotiation point. These are parallel. But the technical talks get to details that we haven't yet heard in the public space. We know that Russia's Vladimir Putin rejected the terms of the ceasefire that Ukraine accepted and instead pushed President Trump to have a more limited restriction just on hitting energy locations. So we already have Vladimir Putin playing some hardball there. We'll see what can be negotiated at these talks over the weekend, but we will bring you an update.
Right. I mean, I think Montana Senator Steve Daines is set to meet China on Saturday. Is that not correct, Margaret?
To meet China?
Yeah.
What do you mean?
I thought he was meeting a Chinese leader in Beijing just to talk about, I don't know, maybe the potential tariffs that are coming on China. Is that still happening?
I haven't been tracking that. Sorry.
Yeah. I mean, I guess this really does for me boil down to China and China US and all the tariffs that we're seeing to date. And so I just wonder how do you view that, like through your lens? I mean, is that front and center for you, or is it Europe or another area of the world?
Well, there are so many important areas of focus. I mean, you can't pick just one, but certainly when it comes to the economy, yes, that is a focus for us that we will continue to talk through because, as you know, that is the key issue for voters, period. Yep. And tariffs are part of that. We will be discussing it on Sunday's program. As for the update on what is to come April 2nd, it certainly seems like the Canadian and Mexican leaders are trying to lower their profiles, speak less. Going into that April 2nd deadline. Chinese officials we also have not heard much about. We do know that there are efforts behind the scenes, certainly by private business, to try to mitigate the impacts of some of this. I thought it was fascinating to see reports that Walmart, for example, was going and trying to negotiate down pricing for their goods. That's an acknowledgement that they will have to raise prices, right?
Exactly.
And they're looking for an offset. Yeah. So that is also known to consumers as rising prices, not a good political experience for them.
No, exactly. Margaret Brennan, thank you so much. We appreciate it. As always, Margaret Brennan, the host of Face the Nation. You can see that CBS Television Network Sunday morning. You can hear Margaret Brennan this weekend on Bloomberg Radio. Listen to Face the Nation Sunday at 2 p.m. in New York, Washington, D.C., and 92.9 FM in Boston. That's Face the Nation this Sunday at 2 on Bloomberg Radio. Let's get a Bloomberg Business Flash. Mr. John Tucker.
All right, seeing some deterioration in the futures right now. The Dow futures down 359. The S&P E-mini futures right now 52 points lower. That's down about 0.9%. The NASDAQ futures down over 1%, 217 points lower right now. We do have a volatile day on tap. Expect volatility with $4.5 trillion worth of options expiring today. FedEx Corporation, those shares right now, they are down 9% pre-market trading. They cut the earnings forecast. Nike also sliding, was down earlier 6%, right now down 8%, signaling declines in profitability. They're blaming tariffs and products from China and Mexico. And among the most actively traded in the S&P 500 pre-market right now, shares of AT&T down about 0.5%. British Telecom said to be approaching AT&T about a possible global unit tie-up. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Damian, Paul.
All right, John Tucker, thank you so much. We appreciate that. Damian Sassower sitting in for Tom Keene. Yes. Tom will be back on Monday. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We are streaming live on YouTube. Head over to youtube.com and search Bloomberg Podcast Live. Lots of news flow coming out of Washington, D.C. Let's get right to it. Jennifer Lawless, politics professor at the University of Virginia, who I will note are not in the men's tournament, but it's just brutal. Jennifer, thanks so much for joining us here. There's lots of ways to go here. Let's just talk with a topic we were just asking Margaret Brennan and CBS about. Reports that Elon Musk is getting briefed about China at the Pentagon today. What do you make of this story? What are the risks? What are the opportunities? What do you make of it?
Well, good morning. The entire thing is quite stunning. It's unheard of for somebody who's not part of the administration or not a member of Congress to receive this kind of briefing, despite the fact that he has received, several types of clearance. The speed with which this briefing is taking place, given that this information was only recently shared with other members of the administration, is also somewhat stunning. And it just demonstrates the access and proximity that Elon Musk has to Donald Trump and the fact that he has a finger in everything, not only domestic policy and the economy and DOGE, but also in national security concerns.
All right, we have to note certainly that President Trump has denied these reports, so we'll see how this news story plays out throughout the day. Another big thing coming out of the Washington, D.C. is an executive order to end the Department of Education. Wow, yeah. I wasn't sure that was a thing, but apparently it is. How is this going to play out?
Well, the executive order begins dismantling the Department of Education. You actually need an act of Congress to get rid of an agency, but there are already members of the House and the Senate who have introduced legislation to do just that. So what Donald Trump did with the executive order was make it clear that he was serious about dismantling the department, and he signaled to members of Congress that they should move forward, and they are. And this, too, is quite stunning for a variety of reasons. We knew that he planned to move student loans outside of the Department of Education, but the department does far more than administer student loans. When we think about education funding, standards and testing, school lunches, and those kinds of programs, access for students who have learning disabilities, all of that is now ostensibly going to get returned to the states. And that means wide variation across the board, no real federal standards. And the extent to which you receive a decent public school education is now going to be contingent more than ever on where you happen to live.
And we see a lot of universities here in the U.S. turning to the public markets to raise money as, I guess, a war chest and against all this. Talk to us a little bit more. I mean, what is the economic impact of all this nonsense with the Department of Education?
It's pretty substantial. I mean, partially it will have to do with public schools, K through 12, which is what I was just talking about. But universities and colleges across the country are also playing a major role. If their funding is linked to this administration or what Donald Trump's priorities and preferences are, they're in a very precarious position. We've seen, for example, the more than $400 million cut to Columbia University a couple of days ago. Penn received notification that it was going to be losing $175 million because of its transgender athlete policy. So universities and colleges across the nation now have an incentive to do two things. First, raise alternative sources of funds so that they can continue to exist if they're targeted, but also, to the extent possible, comply with what Donald Trump is asking for because they rely so heavily on federal funds.
We know that student loans were postponed under the Biden administration during the period of COVID. Talk to us about that front. Do we expect, students or former students to begin paying back their loans anytime soon? And is there any news on that?
The tricky part about that is that the administration has said that they obviously want people to pay them back immediately, that they don't support the delays that the Biden administration implemented. The problem, though, is that they've gutted the people who are the ones monitoring this and the people who can actually share with students the amount that they owe and how they should go about paying this back. And so they seem to be at cross purposes with themselves. We'll see what happens. But the latest reports that I've seen suggest that neither the Department of the Treasury nor Commerce want to absorb responsibility for student loans.
Jennifer, I'd love to talk to you about the politics of the Democratic Party here. You think about the White House, you think about both houses of Congress, the Republicans obviously won all three, but by very, very narrow margins. Yet the Democratic Party has been essentially invisible since President Trump was inaugurated. He takes all the air out of the room. Are you surprised that Democrats haven't stood up to this president more forcefully?
I am. I would say that Democratic attorneys general across the country have been doing an insanely, high-level amount of work to push back through the courts. So I think that the Democratic attorneys general across the country have really risen to the occasion. When it comes to elected members in Washington, it's somewhat puzzling. And we saw last week, based on what Chuck Schumer did, that the party is not entirely on the same page either. I think some Democrats thought that the wind would eventually come out of the Trump sails, and they assumed that it would be sooner rather than later. So they just kind of wanted to sit around and wait for that to happen. It hasn't happened. Others think that they should just compromise because Trump is going to get what he wants anyway. And so maybe the Democrats can extract something. And still others think that because there's unified control in Washington, the Democrats have a responsibility to put up a unified front and try to block everything and then blame Republicans for any unpopular outcome. And unfortunately for the Democratic Party, they're not all on the same page and they're all just kind of flailing.
All right, very good. Jennifer Lawless, thank you so much. We appreciate that. Jennifer Lawless, politics professor at the University of Virginia in lovely Charlottesville, Virginia, with our news in New York City. Michael Barr.
Thank you very much, Paul, Damian, John. London's Heathrow Airport suffered its worst disruption in at least 2 decades due to a nearby fire that cut power to the hub. Hundreds of thousands of passengers are stranded like this man.
Yeah, it's tough. It's obviously a Friday, so, I'll still get home tomorrow, hopefully. It'll just take me an extra day to get back to my wife and my daughter, and they're probably, wishing I would get home already.
The airport will be closed all day Friday with over 1,300 flights canceled or rerouted. The cause of the fire is under investigation, with authorities saying there is currently no indication of foul play. Elon Musk is expected to visit the Pentagon today. The New York Times is reporting that he will get briefed on a top-secret U.S. plan for a potential war with China, a possible sign that his role in the administration is expanding. However, President Trump is vehemently denying reports that Musk will see China war planning at the Pentagon today. Bloomberg government's Maeve Sheehy has more.
We're getting a ton of mixed signals here, but there was a report by the New York Times that Elon Musk would be briefed on the American military's contingency plan for any war with China. And that could possibly set up these conflicts of interest because of Elon Musk's business interests in China. So that was a huge bombshell, although immediately kind of Trump went to Truth Social to say that this was a false report, that he's just visiting the Pentagon. And that's also what we've heard from people like Pete Hegseth.
Bloomberg government's Maeve Sheehy. President Trump posted again on Truth Social this morning, blasting one of the New York Times reporters who broke the story, saying, quote, Elon is not being briefed on anything China by the Department of War. Israel's top court has ordered a temporary halt to Prime Minister Benjamin Netanyahu's dismissal of the country's domestic security chief until his appeal can be heard. The Supreme Court's decision came hours after Netanyahu's cabinet unanimously approved his request to fire Ronen Bar. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Damian, and John.
All right, Michael Barr, thank you so much. We appreciate it. Damian, tell our listeners, tell our viewers what we need to know about Turkey. This is from Tom, the Upper East Side, writes in with a mimosa in his hand.
So look, the Turkish Central Bank had to raise its overnight lending rate by 200 basis points to, Paul, get this number, 46%. I mean, remember, the Fed funds rate here in the U.S. is 4.5%. At 46% in Turkey, they had to sell about $8 billion U.S. dollars to defend the Turkish lira. Once again, Turkey, which has been a favorite trade for a lot of emerging market practitioners, not just this year but last year as well, is in the tank. So, the currency's getting hit, the bonds are getting hit. It's not pretty there. And now hedge funds are coming in to try and, vulture in and pick up the pieces there. So,
what's the fundamental problem with the economy there? Or what's driving this?
I mean, you got to look back and see how did we get to this place, and it's everything to do with President Erdogan and the fact that he initially lost faith in the fact that the central bank should be targeting inflation. So he decided that the central bank should be cutting rates in the face of rising inflation, and that just forced the central bank to lose all credibility, forced the currency to lose all credibility, and then more recently, I'm talking the last year and a half, 2 years, the central bank found religion, and they started to track inflationary pressures once again, Paul, and so a lot of investors came in, said this time's different. Turkey's a place that you want to invest for the long term. And here we are again. The fact that Erdogan just arrested his number one competitor in politics, and that is what's driving rioting in the streets and protests, and that's what's kind of driving it all.
All right. Our next guest is absolutely for you, Damian. Kathy Hepworth, portfolio manager, PGIM Fixed Income. She focuses on fixed income's emerging markets debt. So I'll just introduce her and just bail out, go make a ham sandwich or something. S&P futures off 50 points, 0.9%. The NASDAQ off about 1% here, pre-market trading. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. And we're being brought to you by IBKR. Will U.S. natural gas production exceed 3.27 billion cubic feet in January 2025? At IBKR Forecast Trader, the yes was recently at 9%. Check the data, spot the trends, start predicting today at IBKR. FedEx shares dropping right now. They were down about 8%. The parcel delivery company cutting its full-year earnings forecast for a third consecutive quarter, missing the average analyst estimate. Nike shares also dropping about more than 7%. The sportswear maker delivering a subdued outlook alongside third quarter results. So these earnings results kind of casting a pall over the futures right now. The Dow futures 392 points lower. That's down 0.9%. S&P E-mini futures 1% lower, down 59 points. And the NASDAQ futures ahead of the cash open on Wall Street down 263 points. That is a decline of 1.3%. The group of Magnificent Seven shares right now down just about 20% from the December peak. On the verge of the bear market, a lot of the decline has been driven by shares of Tesla. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul, Damian.
All right, John Tucker, thank you so much. We appreciate that. Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. Our next guest, this is such a plant by you. It's not even funny.
This is the interview of the day.
The day, as Tom Keene would say. I'm going to introduce this guest, maybe get a question in, and then I'll just step aside. Kathy Hepworth, she is a portfolio manager for PGIM Fixed Income, not just PGIM Fixed Income, but the head of the PGIM's Fixed Income's Emerging Markets Debt Team. I just don't know how this happened. Kathy, thank you so much for joining us here in our studio. Really appreciate it. Emerging markets, with geopolitical tensions, with global tariff issues, how is your market kind of performing these days?
Well, the interesting thing is, so far this year, from a total return perspective, when we look at credit, we look at FX, and we look at local rates, it has very positive total return numbers and outperforming other investment grade and even U.S. high yield market segments. And there are reasons for that. Some of that is the attractiveness of the carry in what's deemed to be a still okay world. Big question mark there, though.
Yeah, no, I mean, Kathy's not doing our asset class justice, I just have to say. It is the best performing asset class year to date, and there's a good reason for that. The reason, in my mind, is the FX, right? I mean, This is an FX story. This is the euro versus the dollar and spillover effects, not just into the broader EM, but more specifically, the Eastern European segment of the market. Talk to us a little bit about Poland, Hungary, Czech, the CE4, Romania. I mean, are investors really finally in fixed income putting their money to work there locally?
Well, a couple of things there. There have been decent portfolio flows and FDI flows into some of those countries, Hungary in particular, even Romania. But I think what we saw out of the EU over the past couple of weeks really is a sea change. And I think that can help anchor some of those countries in the region. Of course, in the context of a trade war, some of those economies are quite open economies and they are vulnerable. So you have to balance those different risks, those trade-offs, if you will, as to how those countries might be impacted by a trade war versus are they going to get flows otherwise?
Right. Well, I mean, the periphery there, the EU represents, Paul, 75% of all exports out of Czech, Hungary, Poland, that's sort of Eastern European periphery. So, you can see how it's kind of tracking there. But, the one market which really caught my eye this week, it's the only country in the planet that's actually hiking rates in the face of what we're seeing here, and that's Brazil. They just hiked rates by another, 100 basis points? Where's the policy rate? 14.25, Kathy?
Yeah.
Talk to us about Latin America, about carrying in some of these sort of high-yielding emerging markets.
And that's exactly what's driving those high returns is its carry. So Brazil is doing the right thing, right? In the face of uncertainty and credibility, as it pertains to fiscal policy, actually even more so than inflation in Brazil, they're hiking rates, to try to anchor expectations there. And that's why it's so attractive, I think, to be investing in the currency, as well as some of the local bonds as well. When you think about the vulnerability of Brazil to a global trade war, it's really low when you compare it to, say, a Mexico, right, which clearly has much more direct trade links with the U.S. I'm not saying, it's going to all end badly for Mexico because I think Mexico has some leverage, but Brazil is somewhat differentiated in that regard. So I think those investors in the currency are also looking at from that perspective as well, from the fundamental perspective.
Well, Kathy, I know you've been busy this week, focused on Turkey probably. Talk to us a little bit about what's going on the ground in Turkey.
It's all about confidence and credibility and the market getting ahead of the fact that, oh my God, are we going to get back to that period before the recent change in policy where maybe you're going to see dollarization again in the local Turkish economy. And that's what all those levered investors, I think it's probably close to 20 billion that we've seen outflow from the currency markets and the local bond markets so far this week. We won't know the numbers until next week. Is that going to put pressure on the locals who perhaps are going to be less comfortable owning the Turkish lira? I think the fact that the Turkish Central Bank, hiked the overnight rate this week was a very good thing, a good measure.
Kathy, we're going to ask you to stick around a little minute. We got to get these markets open. And to get the markets open, we turn to John Tucker. John, what do you have for us this morning?
All right, there you have it, the opening bell at the New York Stock Exchange. Right out of the gate, we are lower. The S&P 500 right now, 43 points lower. That is down 0.8%, 56.18 on the index. The Dow Jones Industrial Average down 337 points right now, down 0.75% at 41,630. And the NASDAQ 100, 1% lower right at the start. That is down 210 points. Some of the individual stocks on the move, we've been reporting about this all morning long after the earnings. FedEx shares right now down 10.3%. Important, among other things, because it's kind of a global bellwether. Nike shares, they are down 7.4% right now in the early going. And just a reminder, volatile day on tap, options expiration, triple witching. And that is your opening bell report.
Very good. John Tucker, thank you so much. We appreciate that. Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney. We're still joining Kathy Hepworth, Portfolio Manager, PGIM Fixed Income. Kathy, you mentioned Mexico, that you don't think it's going to end terribly for them. Right. Boy, I could see a scenario where it could end terribly for them. How do you guys think about Mexico?
Mexico has leverage in that the economy between Mexico and the U.S. is so integrated, right? Particularly in the auto sector and some of the electronic sectors, that it's really not in the U.S.'s best interest to impose maximum tariffs on Mexico. So I think in that regard, Mexico has leverage because it's kind of a negative impact on the U.S. economy. And I don't think that that's what the U.S. policymakers actually want to happen. And there is credibility with their institutions. The central bank there, we think, is going to continue to cut rates. And that will help put a floor on growth. But of course, in a really worst case scenario, USMCA is sort of disregarded, then of course, Mexico can enter recession.
Kathy, all eyes are always on the U.S., even in emerging markets. And, I just want to ask you, when you're, in the war room with Greg Peters and Tom Percelli and the U.S. guys over at PGIM, what are they thinking right now? I mean, I think the market, OAS, U.S. front ends are pricing in 2.5 cuts through year end. I think it's backloaded, but still, I mean, it's quite a lot compared to where we just were. I'm wondering, where do you think rates go from here?
Yeah, so caution, right? And tail risks have definitely gotten fatter. So, and we do think the risk of recession has risen. It's not a base case, It makes perfect sense to have 2 or 3 cuts priced in. Is that a Fed put? It's not clear to me that's a Fed put. I still think you need to be cautious in the overall amount of risk that you're taking. But as an active manager, clearly that presents opportunities, underweights and overweights. And, EM is the great asset class to do that, right? Because there are countries who are less vulnerable than other countries, and countries who would be hurt less than those most vulnerable.
Kathy, I can't let you leave without asking you about China. I mean, look at the MSCI. I know we're not equity people here. I know that, Kathy. You don't have to remind me, but the MSCI, China's up like 30%. I think Bob is up something like 70%. Is that just, is that just a trade, or is there any longevity to that? Is there anything structural, fundamental that an investor can get behind there?
I do think there's something fundamental happening in China, and I think that we heard it a few weeks ago. And I think they are now ready to focus on the consumer, to deal properly with the problems in the property sector. And they've been very well behaved, I think, vis-a-vis the Trump administration so far. And there's more yet to come, right? We haven't seen the full extent of what's going to happen with China. But I think that China's much better prepared this time than they were in Trump 1.0.
Last question from me. There are only a very small handful of currencies that are actually down relative to the dollar this year. India and Indonesia are 2 of them, the rupee and the rupee. Talk to us a little bit about Southeast Asia. I mean, how should investors approach that region?
Yeah, so clearly from a currency perspective, I think they're a little bit less attractive. From a local rate perspective, it's more attractive because of deflation. I do think they're going to be cutting rates. Indonesia is a bit of a change, right? Because the market's concerned about the Minister of Finance potentially leaving and the new president having some policy changes. I think in India it was in part because what happened in the fourth quarter, and they used reserves to. So I'm much more constructive on India than I am on Indonesia.
That was a masterclass, folks, in emerging markets. Damian Sassower, Kathy Hepworth, portfolio manager, PGIM Fixed Income. I'd like to be a fly on the wall in that meeting. Gee, let's talk about Turkish lira. But people do that for a living. God bless them. Looking at the markets here, we have some red on the screen as John Tucker was just reporting. S&P off 0.75%. The NASDAQ off nearly 1%. So selling pressure continues for U.S. equities. Well, more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stocks are lowered, and this week the NASDAQ 100, in fact, on track for its 5th consecutive week of declines. You've seen a sell-off in mega caps, weaker than estimated outlooks from bellwethers across a bunch of industries. Wall Street bracing also for extra volatility today. An estimated $4.5 trillion of contracts tied to stocks, indexes, and exchange-traded funds. They are expiring today. NVIDIA's death cross technical pattern keeping traders on high alert about the potential for further declines. In fact, as always, that's one of the most actively traded shares of NVIDIA right now, down 2.25%. Forecast from FedEx to Nike, Micron Technology, and Lennar also disappointing earnings. Nike shares down 8.9%. Micron shares, they're down 7.5%. FedEx shares down 11.3%. And then the home builder Lennar, those shares right now down close to 6%. Overall, the S&P 500, 43 points lower. It's down 0.75%. We're at 56.19 on the index. The Dow Jones Industrial Average down 352 points. Right now, the tech-heavy NASDAQ 100 down 1%, a 201-point decline there. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Damian Paul.
All right, John Tucker, thank you so much. We appreciate that. Damian Sassower sitting in for Tom Keene. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker studio, streaming live on YouTube. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. I think as you think about the rates market and the bond market, there's two camps out there. One camp, if you look at the warp go function on the Bloomberg terminal, say, hey, maybe a couple of rate cuts in 2025. There's another camp out there that's, I think, a little bit bigger than maybe most people realize that says, this Fed, the data suggests they don't need to do anything. Let's see where our next guest comes out. Joanne Bianco, partner at Bond Blocks. Joanne, given what we heard from the Fed on Wednesday, how do you think they're going to proceed for the remainder of 2025?
Well, they've certainly given themselves more time to have better clarity regarding the impact of the new administration's tariff and trade policies and how that will filter down to the economy. So, we take them at their word in terms of them saying that, they have time. They're in a good place with where rates are right now, where the policy rate is. And so that means that they can wait to see how things develop. They can't really front run it. We get that.
Joanne, the Bond Blocks Private Credit CLO ETF launched in December of last year. Ticker symbol PCMM, owns a bunch of different private credit funds. I mean, Antares, Babson, Owl Rock, Golub. How's it performing?
It's performing great. Actually, we're close to 100 million in assets already, and it's what's nice about it is that it is pretty low volatility in terms of the fact that it's floating rate nature, and it throws off a nice income for investors. So, there's low correlation to equities, the rest of fixed income. So it's a true diversifier. And and
a short duration asset, I imagine, as well, right?
Excuse me?
It's more short duration, I imagine, right? Just given the underlying.
Yes.
So probably
floating rate. So 0.2 for effective duration, something like that.
So probably the type of asset you want to hold, Paul, if you're, if you do believe that the Fed's going to stay on hold for longer, right? And not cut rates as aggressively as the market's pricing in right now. I mean, talk to us a little bit, Joanne, about what the market is pricing in right now, which is, call it 2.5 cuts through year end. I mean, has the market gotten ahead of itself? I mean, how do you see the curve reacting to this?
I think the dots show 2 rate cuts this year. It makes sense for people to think that the Fed could, if the economy starts to weaken, cut rates. But, we're really starting at a strong place for the economy. And with the inflationary nature of tariffs, of trade policy, we think it could make it difficult for them to actually make the decision to cut rates. And, again, starting at a strong place for the economy, it could weaken somewhat without it heading into some kind of tailspin.
Joanne, within the Bond Blocks infrastructure fixed income ETFs, where are you seeing the flows these days?
Oh, gosh, we're getting flows across the board. We're getting flows into our credit products from BBB all the way down to CCC. Rated credit products, and those are corporates, and treasuries across the curve. We have people on the short end all the way out to the longest duration treasury, target duration treasury ETF that we offer that's 20 years in duration. So, what's nice about our product suite is now with 27 funds, we're able to offer a lot of different options for investors to be real precise with their exposures in fixed income.
Well, Joanne, I mean, you have that suite of U.S. high-yield industry sector-focused ETFs, which are wonderful. But here's the thing. U.S. high-yield was up 8.2% last year. It's actually underperforming investment grade this year, which we haven't seen in a long, long time. I'm curious, where does the rubber meet the road with high-yield spreads here? I mean, is there a risk to seeing things kind of widen from here, or do you see the asymmetric downside?
I mean, the only reason they're underperforming this year is not that high yield's doing that poorly. It's just that long duration assets are doing better, and that's something that can change on a dime. We've seen that with the volatility of long duration treasuries or corporates. So what we like about high yields, I mean, obviously we like high yield at wider spreads or at the higher yields that we're seeing, because we continue to see strong fundamentals for high yield corporations. So we like the income that they throw off and the total return potential. We think that there's still a very good place to invest in terms of relative value in fixed income.
Joanne, thanks so much for joining us. Always appreciate getting a few minutes of your time. Joanne Bianco, partner at Bond Blocks, with our news in New York City. Here's Michael Barr.
Thank you very much, Paul, Damian, and John. Britain's Heathrow Airport closed for the full day after an electrical substation fire knocked out its power. It has disrupted flights for hundreds of thousands of passengers at one of Europe's biggest travel hubs. London Fire Brigade Deputy Commissioner Jonathan Smith.
Fire involved a transformer comprising of 25,000 litres of cooling oil fully alight. This created a major hazard due to the still live high voltage equipment and the nature of the oil-fueled fire.
The cause of the fire at the substation, now out, is under investigation. President Trump is vehemently denying reports that Elon Musk will see China war planning at the Pentagon today. Bloomberg government's Maeve Sheehy has more.
There's going to be a meeting. Musk is definitely going to the Pentagon. And what we know, or what we have seen from the Wall Street Journal report and the New York Times report, is that Musk will be briefed on, the U.S. government's possible plans for a war with China, which could be very sensitive information. So if those reports are accurate, then that would be possibly a big expansion of Musk's role with the president.
Bloomberg government's Maeve Sheehy. Defense Secretary Pete Hegseth says that the meeting is an informal one on innovation and efficiencies. Israel's top court has ordered a temporary halt to Prime Minister Benjamin Netanyahu's dismissal of the country's domestic security chief until his appeal can be heard. The Supreme Court's decision came hours after Netanyahu's cabinet unanimously approved his request to fire the head of the Shin Bet Internal Security Service, Ronen Bar. Global news 24 hours a day and whenever you want it with the Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. More with Paul, Damian, and John.
All right, John Tucker, thank you. Michael Barr, thank you so much. We appreciate that. Another example of the Trump effect, I think, and John Tucker's been reporting on it this morning. Johnson & Johnson will boost its manufacturing, research, and development and technology investments by more than $55 billion in the U.S. over the next 4 years. That's a 25% increase in investment compared to the previous 4 years.
Reshoring. It's real.
It's real.
I guess it is. I mean, look, this is the big argument we've been seeing. In EM, certainly around Mexico. So, Johnson & Johnson also, I believe Robert Wood Johnson, doesn't he own a professional NFL franchise?
That's what I understand.
Yeah, right. The New York, who's playing quarterback? Oh, right. I didn't know.
They
do have a quarterback. Who doesn't have a quarterback is the New York Giants.
Yes, that's right.
Fields is playing for the Jets, but it's where's Aaron Rodgers play? There aren't many openings yet left. So.
I don't know. Maybe he's going to be still at the Meadowlands.
Yeah.
MetLife Stadium.
Wouldn't that be interesting?
About that. So J&J says total U.S. economic impact estimated to be more than $100 billion per year. So there's another American-based company, a New Jersey-based company, more to the point, New Brunswick, New Jersey, putting the money where the mouth is here in response to incentives, I would say, from the Trump administration. Markets, S&P 500 off 44 points. That's 0.8%. The Nasdaq's off 130 points. That's about 0.8%. So we got some sell-offs in the equity markets to end the week. This is Bloomberg.
You're listening to Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
All right. We've talked a lot of bonds today.
We're going to do more?
Fixed income all over the place.
Credit spreads, maturity walls.
Did you have an input onto the schedule here today? It's just, I'm an equity guy, but Damian Sassower comes in here sitting in for Tom Keene, and look what happens. We're going to continue that. Why not? Let's finish strong. Here's something from Bloomberg News. Credit spreads have room to widen to reflect the rising economic fears that have been battering stocks. However, solid fundamentals signal that credit will remain more resilient than feared, keeping a floor on how far risk assets losses can go. So that's kind of positive. Tatiana Darie, she wrote that. She works for Bloomberg News, and she does all that macro markets strategy stuff. Talk to us about how you're viewing the credit markets today, Tatiana.
Yeah, thanks so much, Paul. Convoluted lead, all it tries to say is that credit will really keep this stock rout contained. So, near a correction now in the S&P 500, we kind of are facing two divergence paths, right? We're either going back to recovery or we're going into a deeper slump. And that deeper slump will depend on the recession and obviously on the implications of the of the market volatility onto the real world. And credit is the primary vector for that. And what I'm trying to say is that fundamentals there are resilient, are solid, and that a credit crunch will not happen because we've had record issuance last year. Corporates have pushed maturities out. So they are in a really good position to weather this volatility.
I want to stay with that point, Tatiana. The fact that corporates have been able to push out, especially high-yield corporates, have pushed out their maturities well beyond 2026. So there's no real, refinance liquidity risk in the market right now per se, but private credit. I think that's really what we're missing here, right? A lot of these companies have tapped the private credit market for short-term loans, and we don't have any data on them when we're looking at public markets like you and I do every day. Talk to us a little bit about the role of private credit in pushing out these maturities and whether or not there's any sort of things lurking in the dark that we're not really exposed to.
Well, there are a lot, but as you mentioned, it's a private market. There's a lot there that we don't know. So credit risk is building in the shadows. That for sure is the case, and I think we won't find out until there is a big blow up or something. Exactly. But in this case, I think for the time being, that kind of works in the market's advantage. I mean, think about 2022. When recession fears were roiling markets. Also, the private credit market actually, did help borrowers, or they have thrown lifelines to those borrowers who were struggling. So they did find sort of a last resort measure there and didn't hurt the economy because they were able to kick the can down the road. So my expectation is that, this fast-growing part of the credit market will sort of also act as a backstop now to struggling borrowers just to weather the volatility a lot longer, because if you look down the line in 2026, 2027, this is a period when the Fed is supposed to cut interest rates back lower, a lot lower. So if the borrowers can make it until then, they are, supposed to cut their borrowing cost then.
Leverage loan market, that's been very vibrant, right?
Yes. I mean, last year, record issuance and data going back to 2013, their spreads together with lower interest rates have come down to the lowest in at least 2 years that Bloomberg data has data for. So they are in a much stronger position, and their maturity wall has also been pushed out.
Tatiana, do you believe that credit spreads are more representative of fundamentals or of market technicals, i.e. of the supply and demand of the bonds and the clearing price that markets have to search for?
That is a great question, and clearly, supply and demand has been sort of the big theme underpinning credit spreads in the past year. But let me tell you this: when there's real fear in the market, this spreads will blow out. Yeah. So I think at the moment we can use that excuse when things are right, when the economy is growing, everything's fine. When we get into issue, it will no longer be as much of a factor as it is now.
See, that's what they say. Equity is soft, debt is hard. So the creditors, they want to get paid back.
They want to get paid back.
They want to get paid back. Tatiana, thank you so much for joining us. Tatiana Darie, macro markets strategist for Bloomberg News, joining us here. Damian, thank you for sitting in. Tom,
thank you, sir.
Stellar job. Tom will be back on Monday. We'll have more coming up. This is Bloomberg Morning.